Good morning, everyone. It's 9 a.m. here in New York City. I'm Brad Smith alongside Brian Sozzi this morning. This is Yahoo Finance Live, and here is what we're watching. U.S. futures stop for a breather, but the momentum of a year-end rally could see fresh highs before we ring in 2024. Investors' hopes of a soft landing are strengthening. We'll ask what risks could derail the optimism.
Microsoft and OpenAI in hot water. The New York Times sues the tech companies for alleged copyright infringement. In a complaint filed Wednesday, the news publisher said OpenAI's ChatGPT and Microsoft's Copilot were trained with the help of the Times pieces.
And EV battles heat up. Tesla reportedly preparing to launch a new updated version of its popular Model Y from its Shanghai plant. Could it help fight off competitors itching for its EV crown, specifically the Warren Buffett-backed BYD, which is riding the wave of a big year? Some breaking news this morning, and it could mean big things for the AI space. The New York Times has sued OpenAI and Microsoft for copyright infringement. Filed in a federal district court in Manhattan, the lawsuit says millions of articles from the Times were used to train AI chatbots that now directly compete with the news publisher. The suit says that the defendants should be held responsible for, quote, billions of dollars in statutory and actual damages, end quote. The suit is a first of its kind, marking the first time a major media organization has sued the companies here. And we've been keeping tabs on shares of both NYT as well as some of the other major news publications here this morning, just to see if there's movement. Not a ton as of right now.
Well, I think you have to really break this down to two areas, Brad. First is, what does it mean to some of the biggest companies in the market? Of course, OpenAI and Microsoft have really just seen their fortunes explode over the past year because the market has viewed these companies as really basically they can do whatever they want in terms of AI and nobody's going to challenge them. What does it mean for a company like Google, which is going to have to ingest large amounts of information from the likes of the New York Times and other major publishers to train its large language models? And, you know, just talking to a lot of the publishers in the industry of late, they're concerned about, first of all, they've had revenue drop from social media. So they're not really getting any revenue from these spaces anymore, Facebook, you name it. Now they're being tasked with giving this information in some form to some of these tech companies, and they're not liking it because it's the path to getting paid is not yet clear.
Yeah, absolutely. I've got the filing actually in front of me right now, and the OpenAI release of ChatGPT has driven its valuation, as we've spoken recently, as the New York Times acknowledges here within the filing, to as high as $90 billion, and the defendants' Gen AI business interests are deeply intertwined. Microsoft recently highlighting that its use of OpenAI's best-in-class frontier models has generated customers, including lead AI startups for Microsoft's Azure AI product. I think at the end of this, them even bringing this up points to the fact that, well, where's our cut? You're using
we all gotta get paid, baby.
Right, you're using and leveraging so much of the data that goes into the ability to have inferential, not just the prompts that come in, but then all the inferential kind of solutions or answers that get popped out on the other side of that. And so with that in mind, I think that's where so many more of the news organizations may be looking for what comes of this, and potentially we'll see if they add on to some of the concerns that now Microsoft and OpenAI have to consider, in addendum to, Latin for you folks out there, the concerns that they've got to think about over in the UK with regard to the Competition and Markets Authority, looking at this combination, not directly a acquisition or merger combination, but a type of investment and almost soft type of merger combination that they're alleging could have taken place as a result of this. And
what this means to big cap tech companies, and you're right on, Brad, it means that I think if you're investing in these stocks, that up and to the right is not necessarily going to be the case over the next few years. There will be challenges to this new business model of AI for these companies. And look, from a publisher standpoint, it's tough times. I think back to when I talked to Robert Thompson, the CEO of News Corp, in September. He's looking for just a tsunami, that was his quote, a tsunami of job loss in the publishing industry because of AI. Who am I to argue with Robert Thompson? I mean, the guy's been around the block.
I'm not going to argue with him. Well, Tesla's Model Y is another major story that we're tracking here this morning. The Model Y reportedly getting a makeover. The EV maker is building out a new version of its Model Y in its Shanghai plant, with production kicking off as soon as mid-2024, according to a new report from Bloomberg. Yahoo Finance senior reporter Pras Subramanian has some of the details on this one. Hey, Pras.
Hey, how you doing? So basically, we heard about this back in March, that they were planning to revamp the Model Y. It was called Project Juniper. Now, the Bloomberg report today does not mention that code name, but it seems as though this project is back on track for mid-2024. They had to stop the factory for a couple times to actually revamp it, right, to make this thing. But I'm kind of curious about why we haven't. So first of all, the Model 3 has been revamped, and it's out in China and other markets, but we haven't gotten that yet.
Do they have nice interiors, Pras? Are they going to get any better, higher quality? Because they're kind of dumpy.
Yeah. Dumpy? I would say that they're definitely minimalist, right? That's probably the way we'd want to refer to it as. But they're doing stuff like adding ambient lighting.
That's kind of cool. That's cool.
Yeah,
that's quick.
A lot of cars have ambient lighting now, right? Even like base cars have that. So it's kind of like maybe a little too late. Look, the Model Y is a great car. It's a best-selling car potentially in the world this year. Tesla needs to do these little slight tweaks to make it a bit more competitive with the space, right? So I see why they're doing this, but I'm kind of curious. When is that going to come to the U.S.? Because we haven't seen the updated Model 3 yet in the U.S.
And it's a touchscreen. It's a giant touchscreen on an interior product.
Yeah, I will say I've driven the Model Y recently. Recently I rented it from Hertz, because they don't allow press to drive those cars, and I found it to be actually a very good product compared to the other EV offerings.
You know, that ambient lighting hits a little bit different, and the screen as well. I mean, you might as well feel like you're in Apple iTunes visualizer mode once you hit that ludicrous mode within that Tesla as well. So let's not hate on the ambient lighting out here.
Okay, fine. Bullish on ambient lighting, but Praz, also BYD out with some news today, and really it's hard to imagine you're on a highway, high-speed highway, and you're going to see driverless cars, but that time may be now.
Yeah, I mean, in BYD in particular as well with Tesla, they're working on their self-driving software there. But you mentioned BYD; they're probably going to pass Tesla in all electric car sales for the first time ever. Wow. Tesla probably going to deliver around 480,000 this quarter. The thinking is that BYD might make around 500,000 this quarter, passing for the first time, not for the year, but for the quarter. Kind of a big deal there because in China that's a huge market for them, and they sell 6 cars below the cost of a Model 3 right now in China. They really have cornered the market on that cheaper entry-level EVs. Are we going to see these cars in the U.S.? That's the next question.
All right, Praz Subramanian, thanks so much. Appreciate it. All right, the markets have rallied to records this year, largely driven by huge gains from the Magnificent Seven. Stocks like Apple have risen nearly 50% year to date, but investors are starting to learn that nothing lasts forever, and that includes with Apple. So, Brad, of course, Apple on a little bit of a 5-day losing streak, underperforming the S&P 500 in large part because of this Apple Watch shenanigans going on. The Apple Watch pulled from sites due to patent concerns there. Unclear what a settlement will look like. But again, as we're learning, I think with the news publishers here, a lot of risks are not priced into the Magnificent Seven and, of course, the broader market.
Well, one of the things that we have to think about, especially with Apple, as you were mentioning that a moment ago, is the fact that they're kind of key growth story here in this next leg, internationally at least, very much still hinges on China. India, of course, that caught a lot of attention this year because of some of the investments finally opening up their first retail footprint, and perhaps even more set to come on the production capacity. But when you think back to China and how much they are reliant on that, I think more notably here, the consumer sentiment shift that we've seen in China over the past 18 to 24 months even, it's really become more of a consumer that has really grown more of their appetite or interest towards purchasing with China-made or China-homegrown, which impacts the story that we were just talking about with Tesla and some of that matriculation of dollars or some of the purchases over to BYD. It impacts Apple in the number of smartphones that they may sell versus a Xiaomi or a Huawei out there as well. And that impacts margins at the end of the day too, which could then hit on earnings and those expectations that we're seeing going into.
And so, look, I understand how people are concerned about what this watch ban might mean to Apple's earnings next year, but it's just the watch.
It's just the watch.
Now, as long as that services business, which is about, I think, over 25% of their business, continues to hum, as people continue to upgrade to new iPhones, that is okay. But what you're seeing here is a lot of headline risk now being priced into a stock, like we mentioned, that is up 50% year to date. That doesn't have a lot of headline risk priced into yet. The bigger picture, of course, what does this watch ban mean to broader manufacturing, I think, for Apple in China over the next decade?
Yeah, absolutely. Well, we were talking about some of those earnings as well here. And just lastly here, as we think about what the earnings picture could look like, decelerating inflation in the Fed, Goldman says, the Fed easing will keep real yields low, support a PE multiple greater than 19x. So that to really round out kind of the earnings expectations going into next year.
Yeah, earnings is supposed to recover.
Yeah.
I was looking at some data from LPL Financial this morning, Brad. Earnings next year are supposed to increase, at least by their estimates, close to 8%. That's pretty good. The question right now is that going to be enough to satisfy what the market has priced in here, about 19 times earnings, like you mentioned?
Exactly. Well, let's talk a little bit more about Goldman and their expectations. The Goldman Sachs firm touted a bright future for China stocks heading into 2023. Strategists bet on a strong recovery from the region, but That hasn't been the case yet. Instead, Japan stocks, they have led gains in Asia, with the Nikkei 225 reaching 33-year highs in 2023. But the Bank of Japan may throw a wrench in that here, and particularly, yes, indeed.
Okay.
It's very well possible. What we've kind of read in on this morning, the Bank of Japan governor had said earlier this week, on Monday at least, what a Christmas, I guess, that the likelihood of achieving the central bank's inflation target gradually rising. So that is perhaps a very good sign there. 2% target increase sufficiently sustainably achieving, rather, that 2% target increase. And then just lastly, they also mentioned that if the virtuous cycle between wages and prices intensifies and the likelihood of achieving their price target in a sustainable, stable manner rises sufficiently, they're going to consider changing policy. So that from the governor of Japan.
Brad, it's I appreciate this. It's hard to get excited about stocks in Japan.
Warren Buffett has found a way
He's excited about it, but Warren Buffett was excited about Japan 6 months ago. Yeah. We're in a very much U.S.-driven narrative in these markets, where companies like Nvidia are rocking and rolling. You have Apple, despite its problems, rocking and rolling. U.S.-focused companies continue to drive this market. Now, I'm not saying you can't find opportunities out in Japan. Rates are still, below 0%, and that's a good thing. But I think the market is saying here they're very U.S.-focused and focused on those countries likely to cut interest rates next year. And it's not just the U.S. That is something likely to play out around the world, just not in Japan, whose rates are below 0%.
Absolutely.
All right, let's get a post-holiday pulse on the U.S. consumer going into next year. Consumer confidence in December has risen to the highest level in 5 months. MasterCard said this week U.S. retail sales rose a decent 3.1% during the crucial holiday shopping season. So is the upbeat consumer data about to get even better as the Fed potentially cuts rates in March 2024, as Goldman Sachs economists predict? Joining us now is Tuan Nguyen, RSM U.S. economist. Tuan, good to see you here this morning. Are you surprised by this consumer resilience we are seeing here in December? And what are some of the biggest risks you see to consumers next year?
We are not totally surprised by the improve in terms of confidence from the consumers, because we know that there's still a lot of excess savings, around $400 billion in terms of excess savings. And it's always great to be on air at the end of the year to talk about good news, right? 2024, we think, will be the year when we begin to experience the new normal. Now, first, when we refer to normal, what we mean is that in 2024, we believe that the economy can achieve its soft landing goal of returning to around 1.8 to 2% growth, the kind of growth that we saw pre-pandemic. And in terms of inflation, in our base case, we think that we will continue to normalize toward the inflation target rate of 2%. And the underlying inflation is expected to end the year around 2.5%. Now, however, this is not quite the 2% that the Federal Reserve is aiming for, and that's really the new aspect of the equation that will come into play, which we believe will be with us for the next 3 to 5 years, because in the next economic period, demographic changes, labor shortages, and re-globalization will lead to some more pressure on prices, which we expect that inflation target will be around 2 to 3% in the next 3 to 5 years, maybe longer than that, which is, of course, higher than the 10-year leading up to the pandemic that we all accustomed to. And if you've been following our prediction closely, we have been making the same case for about a year now, and so far everything seems to be falling into places according to our forecast.
Yeah, steadfast and unmovable with some of those forecasts, indeed, Tuan. You know, as you think about, though, the consumer and the relation to that new normal, if we saw, and however you're kind of thinking about the new normal, does that mean that we'll see a deterioration in consumer resiliency that many economists have been monitoring and seeing show up in the data?
I would not say it would be a deterioration, but I would say everything will go back to trend, the 1.8% to 2% growth rate. And I think in terms of spending, consumer will stay solid, because even if we run out all the excess saving that we have, that only means we're going to go back to trend. That doesn't mean we're going to see a decline. It doesn't mean we're going to see a deterioration in terms of spending power. But again, that's going to depend a lot on the estimate of the amount of excess savings. Now, the $400 billion that I mentioned at the beginning of the show was just the lowest estimate for the excess saving that we've been seeing. It can go up to 1.3 trillion by the end of the third quarter in 2023. So depending on the level of excess savings, and of course, the labor market is continue to be resilient, continue to be strong. So as long as people have their jobs secured, I don't think spending will see a major decline in 2024.
Tuan, I know you're an economist, but you have to be watching what's happening here in the broader stock market. So every day, this is a market that seems like it's on autopilot, pushing to fresh highs, tech stocks, industrials, you name it. Is the market suggesting or trying to price in a surprising economic boom in 2024? And by boom, I don't mean something goofy in terms of U.S. GDP growth, something in the 4 to 5% range, in part fueled by first half interest rate cuts.
I think we can all agree that the market has been quite enjoying what the Federal Reserve has talked so far about their dovish stance, that there might be a cut in 2024, and we agree with that. We think that there's going to be around 100 to 150 basis point cut in 2024. So that's really that's going to be good news for the market, and I think so. It's going to be very hard to talk about pricing at the moment, because I think in the next 3 to 6 months, there are going to be a lot of data coming out, job, inflation, that's going to change the landscape significantly if we see, for example, stronger than expected growth. And I think, in our opinion, that's going to be the number one risk moving forward, because that's going to mean rates going to stay higher for longer, maybe too long for our comfort. That means companies now will have to think about repaying their debts in 2025, when some of the maturity dates will start approaching. So that's going to be a key concerns for not only the overall market, but also our clients, the middle market clients, which are now paying 10% to 15% for borrowing costs.
And so of the data that you're expecting over the next, as you mentioned, 3 to 6 months, does that then initiate a more swift reaction from the Fed to cut rates?
So in our base case, we think the Fed will cut rate around summer, likely June, right? So the market is now pricing for March, pricing for May. So I think the market is a little bit ahead of itself at the moment. So we think that around June, we're going to see the first cut. And likely, because the Fed is data dependent, so more likely than not, the Fed will be a little bit behind the curve, about 1 or 2 months behind the curve, because they have to depend on the data, right? So I think I don't think a March cut is a good option at the moment. We think June would be a better timing.
Tuan Nguyen, who is the RSM U.S. economist. Tuan, thanks so much for taking the time here with us on the day. Appreciate it. Thanks. Well, OpenAI might be getting closer to its first AI hardware device. Legendary designer Jenny Ive and OpenAI's Sam Altman enlisting a team to work on a new AI hardware project for the company. Outgoing Apple executive Tang Tan will join Ive's design firm Lovefrom, which will shape the look and capabilities of the new products, according to Bloomberg. This is the biggest project Ive's company has taken on since he left Apple in 2019. Designer, of course, famous for the products. Yeah.
Look at that resume. Put that on LinkedIn, baby.
Yeah, seriously. You won't be out of a job for long. Well, you could probably just start your own. But the products he helped create under Apple co-founder Steve Jobs, including iPhone, the iPad, the Mac, as you're seeing here on the screen. The OpenAI project is in a very kind of early stage at this point, we should note. Bloomberg reporting that Ives and the company are just beginning to build this team. And you think of what capabilities would really need to kind of be embedded within this technology in order for it to see reception upon any type of announcement, whatever this hardware was that they were able to concoct.
I mean, yeah. I think this is, right now, it looks to be a glamour project for two folks with very big names and a lot of money in their back pockets. Yeah. How are they going to replace my iPhone that I've helped to create?
What if you don't need to carry a phone around anymore?
What does that look like? Is it a piece of plastic put on my lapel? There's certain products out there right now trying to do just that. Do I need that on me? And where does that information go? I don't care about goggles, AI goggles. I think you see Apple going to release those at some point next year. So what? What does the new form factor even look like? It's unclear. I'm very curious to ultimately see what these groups produce, if anything.
Well, I think the curve ultimately comes back to how you normalize what you previously would have done, but tethered to one specific space or experience. You weren't carrying around your landline phone when you grew up.
I tried.
Because of that, now you have your iPhone or your smartphone. We're not carrying around our televisions everywhere. We're simply just watching them on smaller devices or trying to pair them with some other type of hardware that can essentially create that same type of experience elsewhere. So where am I getting at with this? I think the headset, as much as it catches flack, as much as it's wonky in the design right now, if they're able to trim down exactly what it looks like, make it more akin to just glasses that people are putting on instead of some strap that you got to put behind the back of your head to make sure that this heavy thing that has to charge for who knows how long is able to make sure that it gets you throughout the day, and then immerse within that some type of artificial intelligence or look, I'm not the designer. I'm just saying that's what the curve is. You've got to normalize taking something from one environment and putting it into kind of an everyday on-the-go use space.
So then is this Microsoft's backdoor way to finally getting in the phone space or some type of space? And this is a company that clearly missed out on this entire market to Apple, and naturally they're invested in OpenAI. It's unclear.
It is. I mean, that $10 billion investment, which they've only dispersed a fraction of that to this point as it's become reported. I think most notably here, it's just a matter of how they can then layer on all of the other existing services that they do have in the Copilot and whatnot on top of whatever hardware device that looks like.
Imagine trying to walk around with your landline phone.
I don't want to.
I don't want to.
Look, this has been just fine.
Fair enough. All right, now to turmoil in the Red Sea. Yemen's rebels have launched a fresh attack on a container ship heading for Pakistan. Drone and missile attacks in recent weeks have upended shipping through the Red Sea and Suez Canal, causing the world's largest shipping companies to halt operations. But giant operator Maersk announced it would be resuming shipping through the Red Sea this week, leaving investors hoping the disruption caused by attacks would allow companies to raise prices. Shares are falling right now. Unclear as to the economic impact of something like this, Brad. Are there delays for the spring shopping season? Just something to think about.
Yeah, I mean, it's a larger concern for the supply chain management and logistics kind of frame of mind here. And, you can layer on the geopolitical tensions over top of that, because that going into next year, an election year where we know that there's going to be a lot of vitriol and conversation, heavy debate around the U.S.'s role in any of the instances that come about like this, or whatever some of the exogenous threats might be in the next year as well here. I think for this particularly, the last thing that consumers and businesses want to have to think about is another massive supply chain disruption, similar to what we had seen, whether that be in 2022 with regard to the number of chips that weren't able to go into vehicles and or into computers or cell phone devices, or even if you think about the risk of another kind of spike in some of the commodity prices that are out there. Oil has been one of the larger areas to look at within there, as you'd seen some oil companies pull back on the amount of supply that they had navigating through this region. And so that's one area that we've been continuing to track, at least on the immediate onset of what's been taking place in the Red Sea and the shipping companies that are therein as well.
You know what, Brad, I'm just rolling back in my head some of the stories we're covering here this morning, and all these highlight to me a lot of risks in a market that is on autopilot that maybe investors aren't taking into account. Any supply chain disruptions that would hurt the economy in no way is priced into a market trading at record highs. And it's not just industrial companies, it's tech companies, you name it. Any delays, anything that doesn't work out exactly how the market is priced in here, which is priced for perfection, it's not going to be handled good. I don't know when it shows up. Totally wildly unclear on that, but at some point it might.
Yeah, absolutely. Well, one other story that we're tracking here this morning, SoftBank shares, they're rising after receiving a belated Christmas gift. Japanese conglomerate getting over $7.59 billion worth of shares from T-Mobile. The payout, thanks to the 2020 deal to sell Sprint to T-Mobile. Back then, the corporation agreed to forfeit the shares on the condition that it get them back when the telecom company shares grew to a certain level. So this doubles SoftBank's stake in T-Mobile from 3.75% now to 7.64%. And the entirety of that deal, the regulation that it had to pass through, the role that SoftBank was looking for in having more control of the combined entity, and now, yes, a holiday gift that they receive as well as a result of kind of holding out for some of those shares to come on in a delayed fashion as well.
High price point. And I think a lot of U.S.-focused investors they remain unsure how to invest in a SoftBank. They, of course, see Masayoshi Son make various news. He might be a player in this Microsoft Jony Ive type of deal. I think with something like this, you really have to lock into a company like T-Mobile. And I'm looking at a really good note from the JP Morgan team, and they're saying, quote, T-Mobile remains one of the best fundamental stories in communications, and it faces fewer legacy drags like pensions, lead cable costs than its closest peers. T-Mobile has been one of the best growth stories over the past few years, in part because they bought a lot of spectrum, they have a great positioning in the 5G marketplace, they've cut a lot of overhead, and now recently they've enacted a dividend. So T-Mobile's seen as pretty good. Now, I also pulled up a chart on Verizon, AT&T, both companies that are starting to round back into gear on their own. Both of those stocks are yielding close to 7% and should theoretically see better earnings next year. They both are heavily indebted, but with rates pulling back, some of those stocks might be worth another look.
Well, here's one of the other overhangs as well, and I'll take the counter on this because now you have to think about the risk of SoftBank holding on to that size stake, and if they start to unwind some of that stake in order to do what? Throw more capital at the vision funds that they've been able to put together and invest in some of the more cutting edge technology, and then in some cases invest in large kind of either commodity plays or large companies and try to take some type of almost soft activist position, if you will. And so at the end of the day, that is perhaps one of the overhangs or the thoughts that investors still have to think about because of this position that they've been able to amass as well.
Just want my phone to work, Brad.
Look, we just want connectivity. We're carrying it around everywhere. We're sleeping next to these things.
That's very true. All right, all your markets, action straight ahead. Lots of 52-week highs to talk about out there in market land. Stay tuned. You're watching Yahoo Finance.
It's 9:30 a.m. Eastern Time. You know what that means. It's time for the opening bell on Wall Street. That bell has rung, and the confetti is in the air, fluttering down towards the ground at the Nasdaq Composite. We're painting a picture here for you folks. You are seeing the opening bell on Wall Street and in Midtown Manhattan. Let's take a look at the major averages here as we're taking a quick gander at the Dow, the S&P 500, and the Nasdaq here on your screen. We're seeing some mixed activity. The Dow and the S&P 500 flat just barely to the downside. The Nasdaq right now, you're seeing that higher by about 0.1%. Let's get on over to Yahoo Finance's Jared Blickery, standing by at the Wi-Fi Interactive with much more. Hey, Jared.
Hey, Brad. Let's check in on Bitcoin first, and then we'll give the markets a chance to settle here, and we'll check in on them. Bitcoin up a whopping 27 basis points over the trailing 24 hours, but we have been in a holding pattern. Let me just put a 14-day. You can see how we've been just trading in this sideways range, and on a 3-month basis, you can see this is a market that has just been stair-stepping higher. I see nothing bullish. I see nothing bearish in the price action after finding its footing here and finally lifting off in late October. It has sprung up about 60% over the last 3 months. And a lot of this is has to do with the anticipation over a spot Bitcoin ETF. That should be coming, if all goes well, January 10th. That is a Wednesday, a couple weeks from now. But I think beyond that, and there's a lot that's going to happen with Bitcoin beyond that. There's a halving this year. There's a lot of other factors at play that suggest that institutional involvement, the DeFi movement, which was floundering in the wake of the FTX bankruptcy, that all of that is starting to come back now. And the institutionalization of crypto seems to be proceeding on Wall Street. And I wouldn't be surprised finally when we get these Bitcoin ETFs to start seeing them in a wide variety of portfolios by your favorite brokerage houses. Let's take a look at the crypto stocks today, then I'll move into the broader market. And this is an intraday view. Indeed it is. Looks like we got a couple names up 28% here. Let's check on Bit Digital. That's up 121% over the last 3 months. By the way, let me just go back to crypto for a second. I was checking out some of the totals here for some of these other tokens. I usually focus on Bitcoin or Ethereum. Solana has just been screaming higher. Even Hex up 212%. FTT token, don't count that out. That's up 200%. And here's a look at Solana over the last 3 months, 465%. Let's go to the sector action here. And we see, this is over the last 3 months, real quick. We have XLY, that's consumer discretionary up to date. In the number 2 slot, also retail, we got consumer staples, and a bunch of others just treading water, utilities, and it looks like energy. Those are both down about 0.3%.
All right, Jared, thanks so much for keeping close tabs on everything moving and shaking here out of the gates at the opening cross. We've also got some news breaking this morning, and it could mean big things for the AI space. The New York Times has sued OpenAI and Microsoft for copyright infringement, filed in a federal district court in Manhattan. Lawsuit saying millions of articles from the Times were used to train AI chatbots, now directly competing with the news publisher. The suit says that the defendants should be held responsible for billions of dollars in statutory and actual damages. Suit is the first of its kind for sure, marking the first time a major media organization has sued the companies. Let's get to D.A. Davidson Managing Director Gil Luria. Gil, first on outset and reading some of the elements of this filing here, you cover the tech side here. So take us into your thoughts and what Microsoft is really going to have to push back against here.
Well, this is a landmark case that I think we've been waiting for. It was clear that the current framework for protecting intellectual property is going to be challenged by generative AI. The way generative AI works, by training on existing data and generating new creative content and text, is something that intellectual property has, legal framework has not had to deal with. We're going to have to litigate and get the ruling from the court. So this is a very important case that I wouldn't be surprised that if it doesn't go all the way to the United States Supreme Court, because this has to be settled for us to know what the framework is for generative AI. Now, mind you, the fact that New York Times is suing Microsoft may be a little bit of a stretch from a legal perspective, because it's OpenAI that's been doing all this work on the world of data from the internet, and Microsoft doesn't own OpenAI, right? They own a minority stake, and therefore there's an arm's length relationship. It's just the New York Times understands that it makes it a higher profile case to go after Microsoft, and that Microsoft has deeper pockets. But that's part of what we're going to have to find out is, does the lawsuit proceed against OpenAI or against both OpenAI and Microsoft?
Gil, I hear you. It certainly seems like an important moment, important development in the race to develop AI. But Microsoft shares are barely doing nothing on this news. I think they just flipped to slightly in the positive. They are in the positive right now. Is the message really that you risk exiting Microsoft really at your own risk? That Microsoft is still going to put up a lot of big money in 2024 and 2025 as it continues to work with OpenAI and advance its own AI strategies?
That's exactly right. Microsoft has taken the lead on this very important technology revolution, and it looks like this year will be a continuation of that. Once you turn an aircraft carrier and you're past the point of the apex, it starts speeding up. And we expect Microsoft to have accelerating revenue this upcoming year, which is going to be unusual in the world of technology and software. Most companies will have decelerating revenue. Microsoft, because of its leadership position in generative AI, will translate that to growth in Azure, will translate that to growth in its Office products and its GitHub products, and will be still probably the biggest beneficiary from this technology revolution.
Is this the next or recurrence of a late 90s, early 2000s moment for Microsoft? You talk about a case that could potentially go to the Supreme Court, but Microsoft still standing perhaps in a very strong position at the end of the day.
Yeah, I think the case itself is about a lot more than Microsoft. It's about whether reading text and then inferring from it is a violation of intellectual property. So that has to do with how everybody is using this technology, which is, I think, why there's not that much of a reaction to Microsoft. Whatever resolution comes out here will impact everybody equally in terms of implementing the technology. And I think that we've had time to think about it, and where most legal experts seem to be shaking out that it is not a violation of intellectual property to read something in the public domain and use it to infer something. So I think that's why you're seeing the pretty mild response to Microsoft. The three reasons we mentioned: A, they don't own OpenAI. B, it doesn't look like this will hold up. And three, even if it does, it applies to everybody, not just Microsoft.
All right, D.A. Davidson, Managing Director, Gil Loria, thanks for calling, and that is the context we indeed needed. Thanks so much, Gil. All right, it's almost 2024, which means outlooks and stock picks are coming in left and right. This week, we got top stock picks heading into the new year from the folks at Citi. The bank still sees stocks coming out on top despite expecting an economic downturn. Citi's top picks include Delta, General Motors, and KeyBank. And Brad, really, out of all these names, and I know you have your names you're going to talk about, for me, it's General Motors. I'm on Yahoo Finance right now. I clicked on GM. I get taken to their statistics page, valuation measures. Right now, GM shares traded about 4.6 times forward earnings. I mean, this is a market trading at records. You have a market trading at about a forward P of close to 20, and GM's at 4.6 times. I think GM is really focused on 2024 next year, trying to turn around stock price, in part putting out a new $10 billion stock buyback plan. And this is what I asked GM CEO Mary Barra just a few weeks ago on the stock price.
I personally am not happy with where the share price is, and I think, when we look at what we've been through from COVID, from semiconductor shortages, and then from the uncertainty around the UAW strike and the labor situation more broadly, we have certainty now. And we always have had a capital allocation framework, and our target cash was up on average around $18 to $20 billion. And so when you look at that and you look at the cash that we had, we thought this was the right thing to do to return it to our owners.
Brad, I'll wrap this one, the Citi call, really in a bow. Lower interest rates, auto sales probably re-accelerate next year, no pun intended. You have a company like GM that has cut $1 billion in cost. The UAW deal is out of the woods, and they're continuing to launch a bunch of new vehicles.
All right, you were focusing on the ground, so I'm going to go to the sky, perhaps. UAL, DAL, and of course, BA, Boeing Aviation, United, and Delta Airlines in kind of reverse order. So first and foremost, got to talk about Delta here. This was a company that we'd also talked about. This was one of Helene Becker's top picks as well going into next year over at Cowen here. So Delta catching a few bids here from the street going into 2024. For United Airlines, one of the things that they actually talked about here was potentially looking at a 67% upside, and most notably, I think one of the things that they're looking at within the trends that point to success for Delta and United versus some of the other players, Southwest, that has ultimately seen some of its own struggles continue in this holiday season. They said the post-pandemic changes mean lower block hour utilization, more blended travel, more premium economy passenger flow. These trends should still heavily favor network airlines such as Delta and United there. So that one of, or part of the call here for those two airlines here. And then additionally, Boeing. We're coming off of a huge international past 2 weeks for Boeing, getting orders for Lufthansa. You've seen some of the larger kind of planes, the 787, come back into favor, especially within the deliveries that are starting to reinitiate. China, a key region that they're going to be watching for there. Remember that during the depths of the pandemic, this was a sub $100 stock as people essentially looked at the woes that Boeing had and said, how the heck are they going to get past that? Boeing has done that in strides and done that so magnificently thanks to some of the new management, thanks to overturning the mindset that many investors might have looked at this stock and this company and said, there's a pattern of negligence that they're just not going to be able to escape. They've been able to do that, and the stock price is reflecting it.
Brad, real quickly, I'm going to flex for you. I've enjoyed all your conversations with Delta CEO Ed Bastian. I've learned a lot about Delta, and one thing that I've learned is that is a company really poised to take advantage of much lower oil prices.
Yes. Well, they have their own refining capacity as well, which helps them, and that's one of the differentiators for them versus some of the other airlines.
All right, good stuff indeed. All right, more market analysis straight ahead. Stay tuned. You're watching Yahoo Finance. If I had to change my name today, it would be H100 because that is a symbol of success. That is the Nvidia chip, and no doubt about it, that has been the story of the year. It has been that chip that has helped Nvidia cross a $1 trillion market cap, man.
I just realized I was making an N, but for our viewers, it was going the other way. So here is your attempt at N, but NVDA is the ticker symbol we've been tracking all year long here. The gains have been ridiculous as this company is touting the next leg of AI. Generative AI is going to reform everything, how we operate, the productivity. It's everything from applications, the models, and the chips that are all going to make up this industry at the end of the day.
You know what? I'm really wondering if Nvidia is going to have the same performance stock-wise next year as it did this year. Why? Because AMD's coming. And oh yeah, you remember that company Intel? They have new AI chips.
Big AI chips. All the energy coming your way. We're gonna break down if this is gonna continue to trend and how it impacts all these stocks and more.
Would you like my name to be H100?
No, I like your name.
All right, I appreciate it.
It's a good one.
All right.
All we were missing was the bopping cat.
Wait, what was all that?
That was our promo. We're going to be diving deep in Nvidia in the next hour, and you'll definitely want to stay with us for that special programming. But let's take a look at one of the biggest catalysts in the tech sector this year. First, generative AI. It's been the year of AI with scores of positives and negatives. It's safe to say that 24 will only see more chatter and more big market moves around the new technology. At Yahoo Finance, we sat down with some of the leaders in the field. For instance, we had Mark Benioff, who is the Salesforce co-founder and CEO, speak with us about how AI technology is going to create and recreate the entire industries and businesses that we've come to know and appreciate.
This is the most exciting business opportunity of our lifetime, maybe any lifetime. I mean, it's unbelievable what is happening. Every business will get recreated with artificial intelligence. People are here trying to understand how to do that. How do they do it for themselves? How do they do it for their businesses? And I think this is something that is widely unexpected, that a year ago, you're right, we're kind of right in the heart of cloud computing, mobile, social, the enterprise. Now everything is getting augmented with artificial intelligence. You really see AI really in 4 different waves, and the first wave is what we've been experiencing over the last 10 years, which is predictive. Now that predictive wave, well, all these customers, they've had their hands on that for a decade, and that's what's delivering those trillion Einstein transactions every week. Now we're in the new world, generative AI, everybody understands. That's all about these new large language models, the ability to put things together, to have this kind of free-form artificial intelligence in a chatbot type world. The third wave that's coming is more autonomy, more agents. That is where you have the software working on your behalf, doing things without you actually giving it instruction. And the final one is when it's kind of thinking for you.
We also had the chance to speak with Intel CEO Pat Gelsinger on a few occasions this year. Here we discuss which sectors he saw being impacted by the industry the most.
Enterprises are just going to find a lot of critical use cases for this. We showed a couple today, in some of the communications technologies. Imagine real-time translation, transcription, summarization, contextualization. Wow, this is cool. But also cases like manufacturing lines. And we showed even our manufacturing line where high resolution imaging and being able to detect machine variations and being able to improve line yields in our big factories. Wow, 1 day of improvement and I paid for every PC upgrade I would ever do. So all of these use cases I think are important, but consumers as well. Content creators are going to find these to be much more productive ways. And we had a musician here showing off a project that would have taken her weeks now was getting done in a single day because of these new generative capabilities. So much like the Centrino moment, AI PC is for everyone. It's a new generation of PCs and we're just getting started. We had 100 application vendors here with us today and we expect hundreds more are going to find exciting use cases that we haven't even yet imagined for the AI PC. One of the things, and I commented on this in my keynote, that some people are a little bit concerned, it's sort of like artificial intelligence over there. What's it going to do to me? And I suggested that we might reframe it as augmented intelligence. where we're making it part of how we live, how we work. One of the things is, hey, I wear hearing aids, a family defect, and I now have neural enhanced hearing aids. It's not over there. This is part of improving my life and experiences. When it's in my PC, it is making me more productive on a daily basis.
And then there's another big competitor waiting in the wings, AMD. We sat down with CEO Dr. Lisa Su, and she offered insights into how AI has pushed innovations in chip makers in 2023, but also gave a preview into potential headwinds.
It's the most complex chip we've ever built. It's the most complex chip, frankly, in the industry. And the way you do it is, let's call it, with a lot of technology. So we're super excited about the capabilities of MI300. If you think about just how important AI has become, right? AI is like in every conversation, no matter which industry you're in, no matter what you're trying to do. And for AI, you need these extremely powerful GPUs. And they're very, very few companies who can build these things, and I'm just so excited and really love being part of the opportunity to really change the industry with our AI tech. We want them to be as good as possible. We want them to help us answer questions as quickly as possible, and we want the answer to be the right answer. And so these models are going to get much more accurate. They're going to be much more tuned to your data. Particularly when you think about your own personal space or your own enterprise space. And for that, you need lots and lots of GPUs. Today, it is one of those constrained resources. Our job is to make the technology better and ensure that there's plenty of opportunity for, all companies to have access to this great technology. I would say that this moment is, just unlike any other moment. So, I've been in this industry, 30 plus years. We've seen a lot of great technology, but AI is a step function above that in terms of what we believe the potential is. Now, we do have to put in safeguards. I think there's a lot of work going on in that area, but the upside, far outweighs the potential risks.
And to round it out, Andrea Guerzoni, EY Global Vice Chair, gave us all more nuance into some of the challenges business leaders are having to keep up.
On top of every CEO's agenda, it's the buzzword now. But at the same time, when it comes down to adoption and understanding really the value that can be extracted from this technology, it becomes much more complicated. So our survey showed very clearly that almost 2/3 of the 1,200 CEOs we interviewed are struggling with the actual application, and they are equipping themselves in terms of talent, in terms of educating the management teams, hiring the right people, but at the same time, the application is not that easy.
Andrea, what do the partnerships look like when they're talking about furthering their progress and adopting AI? What does that strategy look like? What are you hearing from business leaders in terms of how they're approaching that?
I think they are very cautious. I think the technology is evolving extremely fast, and there's a huge fear of making mistakes. The cost associated with this technology is very high. The development of proprietary language model to ensure safety in the use and effectiveness in the adoption, it's an element of complexity. So they are trying really very hard to understand which use cases can be adopted first to test the technology, to develop further use cases down the line. I think the first applications are really more related to efficiency, trying really to reduce costs, to trying really to understand better how this technology can evolve. And I think the next step will be definitely the impact that these technologies can have on the top line growth. And finally, really devising a strategy that would allow companies to redesign their business models, their processes.
We've got all your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
An all-time high is firmly in sight for the S&P 500 as the Santa Claus rally rolls on to close out this year. Let's take a beat. Brad and I look at some stocks that are currently at 52-week highs as we speak. One of my all-time favorites, Costco, formerly Company of the Year. We've got Chipotle on here and Lululemon. And Brad, we at Yahoo Finance just launched a new tool for the Yahoo Finance community. It's called Yahoo Finance Compare. And I'm on this compare page right now on our homepage, and I'm looking at the price ratio section. Yeah. And you really ultimately inspired this for me because you were talking about P ratios earlier in the show. The P ratio on Lululemon, 36 times. Ford, that is. Costco, 43 times. Chipotle, 43 times. And we're talking about markets at record highs. And this is reflected in some of these companies. So that is first and foremost. Secondarily, all three of those companies are some of the fundamentally strongest consumer-oriented names in the entire market. And as we have learned, the consumer has continued to surprise to the upside. That means packed stores at Lululemon, packed stores at Costco, and packed restaurants at Chipotle. And all three of these companies have the financials for the past 6 months to back up where the stocks are trading now.
I think one of the larger questions, too, because you're looking at three very different companies and where they can fit on the consumer spending spectrum. Lululemon still looked at as very much a high value and one of the more costly parts of the athleisure, athletic apparel, and also footwear, and one of the next catalysts perhaps that investors are going to need to look to is how well they do in men's footwear and an expansion in men's footwear coming off of what they've already done in launching women's. We were just talking about the slides. The slides was the first entry into men's
You're
footwear.
a Nike guy. Don't sit here and tell me you think Lululemon's going to track Nike.
I try everybody. I'm not saying they're going to track them down.
That's why I just have to do the follow. I just want to hear that.
Okay.
That's it. That's all I want to hear.
I mean, look, it's going to be difficult to track down the most successful brand that the swoosh has been.
There we go. We got Brad Jack.
And athletic
we got it back.
apparel category
okay, all right.
in the world here. So you think about that, but you think about what Lululemon's going to need to do. They're going to have to get it right on footwear. They're going to have to get it right on price point as well at a time where consumers are going to increasingly push back on some of those prices, regardless of how much they might be willing to spend into a luxury component like that. Also on the Chipotle side, you're going to be looking at, of course, the guacamole attachment rate to see if they're trading out of the guacamole. And then lastly here, I'll hit Costco. That's where the consumer might, and the catalyst here for the consumer at Costco is buying in bulk, looking for deals, being more cost value conscious here. And that's something that could benefit them.
All right, two quick shout outs. I'm realizing as you're talking about Lululemon, I spent about close to $800 there this past Christmas. A lot of gifts, lots of just stuff, but it was high quality stuff. And then lastly, Chipotle, I would watch out this. For mid-2024, that wage rate in California is slated to go to $20 an hour. Our very own Brooke DePalma has been writing about this extensively, and it does present a key risk to Chipotle. If you're starting to pay your workers $20 an hour in California, which is their largest market, is your bowl going to double in price?
You've got people in the Slack channel right now asking you what you spent $800 on at Lululemon.
It could add up.
It actually does. You buy 8 hoodies. I'll defend you on this one. You get 8 hoodies for 8 special friends and family members. Then, hey, they're going to feel great. And, hey, your wallet is going to take an $800 hit.
Where they get you is the T-shirts. So the T-shirts, you're thinking, I'm going to pick one up off the shelf. They look affordable. They're really like $68, $70. After tax, $75? You pick up 3 of them, and suddenly you're looking at an $800 tab.
Adds up quick.
It adds up quick. All right, more market analysis straight ahead. We got a really cool hour of programming coming up here next on Yahoo Finance. Big focus on Nvidia and some of the big tech stocks that you love to trade.
Good morning, everyone. Welcome back to Yahoo Finance Live. I'm Brad Smith alongside Brian Sazi. 2023 was the year of artificial intelligence, and Silicon Valley could not get enough of it. Many companies were able to ride the AI hype wave, but Nvidia easily became the poster child. Nvidia's stock is up more than 237% this year. The driving force behind its surge, the company's relentless demand for its AI chips. So, Sazi, let's recap the year that was for Nvidia and what investors can expect in the year ahead. And let's break this down perhaps into the good, the bad, the ugly. I want to start with the good because people have called me the Grinch going into this holiday season. And so I want to be a little bit of a holiday cheermeister, if you will, here as we give this outlook. The good here is that this data center strength and the business there has seen growth unlike any segments that we have seen for a business in recent history here. And what's that growth looking like? I mean, we're talking about year over year. You think about the last quarter, some 280% growth year over year from the same time last year in that data center business. That's what's going to catapult so much of the capital expenditures being thrust back in towards other elements of the business where they're investing heavily. I think back to a JP Morgan December 15th semiconductor note that they put out saying that artificial intelligence and deep learning are going to garner a lot of investor attention, but as a sub-segment of data center, and they do anticipate AI being one of the fastest growing silicon opportunities in all of semiconductors.
Yeah, and you're really getting the sense there. It is a massive, or it has been a massive market share grab, Brad, for Nvidia throughout this year, just gobbling up market share from its competitors in large part because it remains really, by some estimates, a couple of years ahead of its rivals in chip development. But if you're going to be the good guy, I guess I'm going to have to be the bad guy. One bad thing, and it kind of plays along what Brad was just saying, the bad thing for Nvidia is that the market investors are absolutely obsessed with Nvidia.
It's a good thing, but it's a bad thing.
They are obsessed with it. They are only expecting greatness from Nvidia, as they probably should be. This is a company that has consistently this year squashed analyst estimates to the extent I have never seen before in my close to 20 years doing this. They're not only just beating estimates or earnings estimates and sales estimates by a couple pennies, they're blowing everybody away. So they've reset expectations much higher. The problem with that is if they don't continue to grow at these rates in 2024, are we talking about when Nvidia reports in the first half of next year, do investors sell that news because they're not getting triple-digit earnings growth from Nvidia and maybe not getting 12% quarter-over-quarter sales growth? That is, of course, wildly unclear, but again, a lot of expectations priced in Nvidia here in a big, big way.
Yeah, when you see margins and particularly when that margin growth starts to deteriorate, or at least the growth declines or decelerates, that's something that investors start to fade at one point or another. But we got to talk about the ugly as well, because that takes us a little bit more international. You want me to do that one? Fine. Well, the ugly is the international scene right now. They've got a quandary that they found themselves in the middle of right now, where they've got to figure out how to kind of walk the tightrope of satisfying a lot of the restrictions that have come forward here in this tit for tat that has really continued to move forward and just found its way over into the artificial intelligence chip landscape, and Nvidia trying to walk that tightrope and that balance beam very carefully. But they have to make sure that they're not a political punching bag here going into next year within this broader space too.
That is right on, Brad. And really the risk, the China risk is really something that a lot of analysts are in fact calling out. You could see a deceleration in growth rates in the first and second quarter in large part because these chips are not in fact going to China. Bottom line is this though, and really for me, Brad, is a really great quote by the Evercore ISI team. They're saying this, quote, "Nvidia is on a clear path to becoming the most valuable company in the market." And wow, that really left an impression on me, Brad. Not the most valuable company in the tech space, not the most valuable company in a specific sector, the entire stock market, meaning Nvidia would supplant the likes of an Apple and Microsoft. And to me, that's just absolutely mind-blowing.
I mean, well, if you think about their ramp just to get to $1 trillion valuation, they were able to do that faster than a lot of those other players as well. And so no doubt that that's going to be in focus as we move throughout 2024. Nvidia joined the $1 trillion valuation club. This year, as shares, they skyrocketed. And so here, to map out the stock moves so far, we've got Yahoo Finance's Jared Blickery. Jared, we were just breaking down their rise to that $1 trillion valuation club.
Yeah, some excellent commentary there. And let's just take a look at the semiconductor sector overall. I have, this is showing market cap weightings here. So Nvidia, $1.217 trillion, and that's about double the next two competitors. That's Broadcom at $532 million and Taiwan Semi at $544 million. And let's just check out the year-to-date totals in terms of the stock return. And Nvidia, by far and away the leader, up 237%. Taiwan Semi up 40%, and Broadcom up a very respectable 103%. But I also want to focus on AMD and Intel. And what I'm going to do is go through the year in stock prices for each of these three companies, beginning with Nvidia. And Brian's comments about that $1 trillion valuation, very much important. That's a huge psychological number. One of the things in terms of valuation that stood out to me was after the reporting on earnings here, Nvidia on May 25th, 2023 gained $184 billion. That was the third biggest gain in U.S. stock market history, only behind Apple and Amazon and a couple dates on last year. And then we got to this relatively high plateau here. We've just been consolidating over the last few months. This was the result of another earnings result, and I don't want people to focus on the numbers here. Just look at this chart of data center revenue in millions of dollars, all the way shooting past $1 billion in one quarter, basically doubling what had been done in the prior quarter. And so that generated a lot of enthusiasm, but we still see the stock kind of trading sideways here, haven't quite found that catalyst. Here's something that was negatively impacting the stock at times, Nvidia being subject to these export controls. It's a little dance that they have to play with the regulators in the US. But just check out AMD by comparison here. One of the great moves that we've seen in chips came in the last month, and here's what happened with AMD. They announced their new Nvidia competitor, the MI300X. That is the largest graphics processor designed for AI-based servers. And then with respect to Intel, I just want to go through this last little bit here. Another positive development for Intel, which really surged over the last month, and that was them debuting their Ultra processors at AI Everywhere event. So Sazi, going to send it back to you here.
Yeah, Jared, I got so excited about what's happening over at Intel. I actually had to leave the studio, climb into the Yahoo Finance newsroom, run over to my desk and find out some new stats on the company. Ultimately, we have a story right now on our homepage, yahoofinance.com, really explaining the impressive rally in Intel shares so far in December. Stock's up about 14%, outperforming the S&P 500. Stock is up 90% year to date. And keep in mind, Intel was seen as an also-ran in 2022. Stock fell about 49%. Comeback year for Intel. So you're wondering, well, Saz, why the heck is all this happening to a company like Intel in a market that absolutely loves AMD and Nvidia? And I really boiled it down to a couple things in that story now on our homepage. One, innovation. Jared mentioned those new Core Ultra processors that Intel just unveiled. They also teased the upcoming release of Gaudi 3. That is their AI software chips that are going to hit the market. And now Intel is seen as a potential big player in the AI industry. That was not necessarily the case, guys, back in 2022. Next up here, momentum. This Intel turnaround story is starting to feed on itself. CEO Pat Gelsinger just telling me a couple weeks ago he believes the company is just the worst is behind Intel at this point, and maybe he is in fact onto something. And last but not least, as this top line reaccelerates for Intel because of its AI chips, its new AI PC chips, whatever it is, this is a company that has pulled out billions of dollars in costs over the past 2 years as it has deeply restructured its operations. So you put an accelerating top line against a lower cost base, and I think you're getting what you're seeing in Intel. And there we go. More markets analysis straight ahead. Maybe we'll talk some Intel, but I can tell you this, we have a lot more coming on Nvidia. You're watching Yahoo Finance.
Well, no doubt about it, Nvidia has had an outstanding year. The company's breakthrough in generative AI helping spark a rally among tech and AI-related stocks in the first half of 2023. Shares are up 237% for NVDA this year, tripling in price. But does the stock have more room to run in 2024? That's the big question here. And for more on Nvidia, we're joined by Patrick Moorhead, More Insights and Strategy founder and CEO, and chief analyst, and Paul Meeks as well, veteran tech investor. Thanks to both of you so much for joining us here. So let's start with the big question here. Is there more room to run for Nvidia in the year ahead? And what would be the main catalyst that investors can anticipate would drive some of those returns? Patrick, I'll go to you first on this.
Yeah, so in 2024 for Nvidia, there's no doubt there's a lot more room to grow from a revenue and a profit dollar standpoint. I think the biggest question is that going to translate into share gains, or is it priced in? What this growth is going to be driven by is the continued growth of the generative AI market, continued training, and then we're also going to see some big action on the inference side, as we saw in machine learning about 4 or 5 years ago when the growth went from training to inference. But no doubt there's more room here for Nvidia.
Paul, let me get over to you. I referenced an Evercore note that came out a little while ago, really suggesting that Nvidia could go on to become the most valuable company in the entire stock market. Do you see that happening?
I think there's a chance for it to happen. You think about it, it's going to have to increase its market cap at least 100% from here. I think it could happen, but I would not be bold enough to make that claim yet. But I do concur with Patrick on his thesis and the bull-bear debate in the previous segment. I'm a bull supporter of the thesis on this particular stock. And when you ask about a catalyst, I look at it a little bit differently. The way I look at this is next year, the company, and I'm not stretching here, these are Wall Street consensus estimates, is to grow its earnings per share 70%. And it's trading at 24 times those earnings. And so it's trading at a PEG ratio of less than half. And then you take a look at the S&P 500. It's trading at a PEG ratio of about 2 times because the market's trading at about 20 times. And I don't think that the street is going to be right. And it should be bold enough to say that the EPS for the S&P 500 is going to grow 10%. I think it's going to be less than that. And so my relative comparison, Nvidia to the S&P 500 valuation, is even more skewed in my favor. So yes, this is my best tech idea going into 2024.
Is 2024, just to add on and follow on that, is it a year where you anticipate that we'll see margin growth deceleration, which typically is one of the headwinds for the stock price action, especially for a company like Nvidia? Paul, I'll go to you on that.
Me?
Yes.
Yeah. So the way I look at it is this year the company's supposed to earn about $20 per share. When I say this year, it's fiscal 25. That actually begins on February 1st of 24. The reason that the stock is probably consolidated since the summer began, after it had its big gap up on the first AI-driven quarter, is people probably believe that we go from $20 EPS this year to back to 3, which is the EPS in the prior period. And I just don't think that we'll have a deceleration that dramatic. Yes, we'll have a deceleration, but not that dramatic. And then people will say, wow, I think that growth rate is going to be robust for a couple of years, and it deserves a much higher PEG ratio and absolute PE ratio.
Patrick, let's take the other side of the coin here. If one runs the math on Nvidia and their conclusion is the stock is priced for perfection, it's feeling a little bubbly, is it the right move to look for derivative trades that play in the Nvidia ecosystem? And I bring this up because I just got to know from Morgan Stanley, Adam Jonas covers the auto space, but his first sentence out of the gate here, Patrick, he thinks Tesla should be viewed as an AI company. And guess what? Those those software systems in Tesla, I believe, use NVIDIA chips. So maybe that's the better way to go.
Yeah, I think the downstream, if you look at the entire ecosystem, I think those could be pretty good plays, because in the end, if NVIDIA is going to be selling cards for training and inference, somebody's going to be using them and theoretically deriving value. And we've seen a couple picks here that have taken advantage of it. Microsoft is one of them, and the other one is Salesforce. And then the big question is, hey, what about this wave two? I believe that we're going to see a lot of picks here that would be second order. I like to call them wave two numbers. And on the chip side, right, you're going to see Qualcomm, you're going to see Intel, you're going to see Micron, because the downstream effects of increasing the training. And I think the AI PC, I think we're going to see the potential for a super cycle in AI PCs and AI smartphones in the middle of this year. And I think a lot of the action will be on the back half in terms of the sales, but you're going to start seeing in the first half a lot of evidence of the potential for this downstream super cycle. And then on the service provider side, right, we haven't seen a lot of action on Google. I think you're going to see that. We've seen a little bit out of Oracle, which is good. And then finally, on the SaaS side, companies like Adobe, that we saw a little bit of gains from out there. Box, as an example, their ability to charge $10, $20, $30 incrementally a month is going to be very interesting to watch.
You hit on something, and that's tail end there, very key, which is the pricing mechanism and strategies that all of these companies are really going to have to enact. And, you know, as this last question, I'll let both of you get a brief bit of time here, but is generative AI layered into perhaps a PC market that's already hopefully hit a trough, and smartphone and other devices market that is expecting generative AI to be that next kind of inflection point for initiating consumer demand? Is generative AI enough to spur consumer demand, regardless of the pricing strategy that's going to need to get put forward here at a time where we know consumers are going to be more discretionary or more diligent about how they are spending, whether that be on the B2C or B2B side? Patrick, I'll go to you first, and then we'll end on Paul.
Yeah, I think generative AI, if marketed correctly, and that's a big if, so I'm going to hedge myself a little bit, could be the driver. So you look at HP, you look at Dell, you look at Lenovo, and then all the suppliers to them, the AMDs, the Qualcomms, and the Intel. I do believe that we're going to see a lot of end user pull based on what you can do on device. And essentially, the value prop is, whether it's a PC or a phone, I can do what I can do in the cloud, but I can do it better. I can do it more private, and I can do it more securely. Then on the software side, people are taking two schools of thought here. On the Zoom side, they're giving it away for free for now, even though they're probably paying 10x what they would do for machine learning, in order to gain share and to protect the people, protect the users that they have. The other hand, you have Microsoft on Microsoft 365 that's able to get $15 to $30 more per head. And then you have a little bit of action in between, like Salesforce. But my early prognosis is positive. Generative AI is providing the value, and the people paying for it are paying extra money for it. I know it sounds basic, but I wasn't there 3 months ago. It was more of a could be.
Right. Good analysis, guys. Really appreciate it. Exactly what we needed today. Patrick Moorhead, More Insights and Strategy founder, CEO, and chief analyst, and Paul Meeks, veteran tech investor. Happy New Year to you both.
Best wishes to you.
Thank you. All right, the surge in generative AI is unleashing an innovation wave at the world's largest tech companies. And while Nvidia has become a game changer in the chip space, there are still a few companies that have launched competing products and are worth keeping an eye on next year, namely AMD and Intel. I spoke with Dr. Lisa Su, AMD chair and CEO, about the company's latest chip breakthroughs and what it means for its bottom line next year.
We've been working on this roadmap for over 5 years. I mean, these are the types of things, you don't just wake up one day and say, hey, I want to build an AI chip. But it's been a steady progress, right? I mean, you know very much what we've been able to do with our EPYC product line for all of these large data centers and cloud installations. We're on our 4th generation with, our Zen 4 technology. It's very similar on the GPU side. We're launching what we call our 3rd generation of our GPU architecture. Every generation it gets better. Every generation we work really closely with our customers and partners on how to make their software better and how to make our systems better. So yeah, it takes quite a long time to do this. But what makes today so special is it's not just it's a great product, because great products come along all the time, but it's also a great product at the right time, solving the right problem for the industry.
We also had Pat Gelsinger, Intel CEO, telling us how it plans to become a leader in innovation and manufacturing once again.
We manufacture chips at scale. We manufacture our chips, but increasingly, as you know, Sazi, we're becoming a manufacturer for everybody's chips as well. And then you have the fabless model, and that's companies like Qualcomm, Nvidia, AMD, and I have many products that I build as well. So essentially, I'm building 2 companies inside of one, a major foundry manufacturer at scale and a fabless company. So in some ways I compete, but in other ways, hey, I want to manufacture all of Nvidia's chips, all of AMD's chips, as well as all of Intel's chips going forward. And we are rebuilding the world's supply chains for the most important resource of the future.
Brad, I know we've been covering this move in Nvidia and the valuation on some of these stocks, but you still get the sense, at least from a fundamental standpoint, they may only be scratching the surface. I think back to what AMD CEO Lisa Su just told me. She has over $2 billion in orders for its latest round of AI chips, and she suggested they're ready to raise that amount even more. So middle of 2024, are we looking for a big Nvidia-like guidance raise from AMD? I think it should be on the table.
There are going to be 2 other areas for investors to keep a close eye on, and it's one on the labor side, and it's also on the materials side too. You think about the labor and necessary talent in order to continue to build on top of and iterate on top of what these companies have already discovered. It's going to come down to top talent making their way into these businesses and then providing that next inflection point on the ingenuity side that then generates even more demand from the market. And then on top of that, materials to build out these chips. You think about, and this is perhaps where investors should be looking across the entire ecosystem to see exactly where in the manufacturing they're going to have to lean into raw materials such as copper, raw materials such as tin or aluminum, and see exactly what the market demand looks like and where that demand is actually being outpaced by the actual supply. And that is something I think within the core countries that are producing those commodities and raw materials, that's important for investors to really evaluate as part of this broader landscape too.
I need to spend a day in one of these chip factories watching how they make this stuff.
I would love to. Cool. Yeah. Let's go to a chip factory one day.
I would love to. Let's do it.
Yeah. All your markets action ahead. Stay tuned. We're going to stay right here. Not going to the chip factory just yet. You're watching Yahoo Finance. Stocks are rallying around optimism that the Federal Reserve may have successfully pulled off a soft landing. After hiking interest rates 11 times since March 2022 in its fight to bring inflation back down to its target of 2% in December, the Fed announced that it would hold interest rates at a 22-year high for the third consecutive time, but stocks have rallied over the idea of rate cuts to come in 2024. We've had a lot of Fed speak this year, long before the dovish pivot. We spoke with noted dove Austin Goolsbee of the Chicago Fed, one of the more interesting additions to the FOMC. And in July, he stressed how the Fed was reading data and how important it is for any decisions the Fed makes.
We're going to get multiple important observations about both inflation and the job market between now and September. And I'm open to reading the data. If there's a major change of conditions, I haven't made up my mind for what should happen in September. But this golden path, which so far we're sticking on that line, that would be a triumph, and it's certainly a possibility at this point.
Certainly a possibility to skip September or to stop raising rates if you have enough good inflation by September.
As I say, all of the above. There's nothing off the table. There's nothing specifically on the table. Let's not tie our hands of what we're going to do before we get the information. So far, we've gotten inflation down without a recession, and indeed without even raising the unemployment rate, a thing that many economists said was literally impossible. So let's keep our eye on the new monthly inflations in core, both goods and services and housing, because the goods inflation, we've seen nice progress. Housing is now supposed to start dropping. The housing inflation is supposed to start dropping as we get the market rents kind of flowing through into the way the index is calculated. And anything that we're getting in the near term reducing services inflation is in a sense just an added bonus, because we have not thought, we have always thought that to be the stickiest part of inflation. That we've seen actually some progress on that front was unexpected and a nice bonus.
More recently, we spoke with Richmond Fed President Tom Barkin, who noted that while data had cooled to the Fed's liking, consistency was ultimately the key for the Fed moving forward.
I do think the data as it's come in over the last 6 to 7 weeks has been much more in line with what I'm saying, which is everything's normalizing. Demand is normalizing, employment's normalizing, inflation's normalizing. It's not falling off a cliff, which is good news. It's normalizing, but it's definitely not frothy the way that the data seem to be showing in the third quarter.
All right, so given all of that, how does that inform your specific view for the policy path going forward? The median projection for 3 rate cuts next year. Do you fall into that camp?
Well, I'd start by saying, we have 3% PCE inflation. We have 3.7% unemployment. And if you had given me those numbers a year ago, I think I would have taken them. I mean, it's a pretty remarkable change over the last year. Now, we're not yet done with inflation. I'm hopeful the numbers will come down over the coming months. Certainly the comps will be attractive for the next 4 months. So I'm expecting inflation to come back down. We'll see what happens to demand. Like I said, I think it's normalizing, not falling off a cliff, but I'm paying close attention to what we're hearing. And I think you do see some segments of the economy weakening. Some of the consumer products areas where prices have increased, home improvement, apparel, those are segments that feel weaker, but we'll see what happens when we get into the new year. And I'm just looking for conviction. I'm looking for conviction that inflation is coming back to target. I'm looking for conviction that that's the place to focus as we sort of balance the dual sides of our mandate.
Much more analysis on all things Fed straight ahead on Yahoo Finance.
In November, we saw inflation come down to 3.1% year over year, but something that's keeping inflation high is rents. That rose 6.9%, and still some investors remain optimistic that the Fed might stick the soft landing, but getting inflation down to 2% has proven to be more difficult than expected. Our next guests both say inflation is going down, and that is the key to the soft landing, but the Fed might be its biggest own enemy. Now, we have Claudia Sahm, who is the Sahm Consulting founder, and Lee Munson, who is the Portfolio Wealth Advisors president and CIO here. Great to have you both here with us on this holiday abbreviated trading week, at least. However, the economy continues to tick on here, of course, every day. Claudia, I want to begin with you. When you think about the Fed getting down to that 2% personal or set target that they've put out there, what is the key element, especially within their own data dependency, that is actually going to get them there?
The Fed needs to wake up. They have beaten us over the head that they are data driven, and they are. But come on, inflation has come down from a peak of 9% to 3%. That is a massive disinflation. I understand they want to see conviction, but what are you looking at? I mean, this is really moving. And so I understand. I understand the psychology of the Fed. There was absolutely a case for them to cut in December. I don't expect them to cut until May. And I don't really think it matters, frankly, for the soft landing, but it's time for them to get out of the way and look at the data.
Lee, good to see you, my man. Does this all end badly for investors here? This is a market trading at record highs, and the expectations that rates are cut several times next year. But maybe they just don't get cut, and investors are just handed not good things.
Well, how are we any different from January? Remember January, buy tech stocks on a Fed cut, and then it became, we kept moving the goalposts. Maybe you have to buy tech stocks because of AI or some other thing. But here's the thing. What's different from where we were in January? Yes, more time has passed. But look at the employment cost index. I love looking at ECI because until you start normalizing, just get back to like the 5-year average on the ECI, right? Which it's over 4. The 5-year average is 3.5. It needs to be at 3 or lower. Just that little indicator right there tells us that wage labor is still high. It's going to be a problem, and the Fed is looking at that. I think we have to understand this is not about economic statistics. This is about a very wealthy man. His name's Jay Powell, and he's thinking about what his legacy is and what's going to be on his tombstone. Now,
what does this tombstone say, if you had to write it today?
He kept rates high all through 2024, pissed off a lot of investors, and went down as Paul Volcker and not Arthur Burns. Arthur Burns was a fine central banker, but his legacy was tarnished. And I think until we slay inflation, until we see, we've got to see PCE at a 2 handle for 6 months. I just would say a 2.9, a 2.8. But until we see a 2 point something for a minimum of 3 to 6 months, I don't see why the Fed is going to jump the gun just because it might be more comfortable for us, just because we would prefer that, just because that would keep this stock rally going. I don't think the Fed cares, and I think we're going to see more volatility going into January and February as people realize and reality sets in. This isn't about the statistics, and we have to see 2 point something for multiple months.
Claudia, what say you? What is the perhaps calling card? What's on the I won't say tombstone, but what is perhaps the legacy of Jerome Powell, especially after this broader cycle that they have had to navigate through?
The first thing I would push back on is our statistics are a reflection of our reality, right? This is just a measurement, and unit labor costs have come down, productivity is up. I mean, like, we have a lot to say here, and I hear you. It's hard to know where we are in the rebalancing, and I think Jay Powell comes out of this very well. He is not the Volcker. The Fed knows how to get inflation down to 2% really fast. That's what Volcker did. He caused a recession because they felt they needed it. This Fed has never said they needed a recession, and that's absolutely the right call. And 2023 vindicated that call.
Lee, let me get back to you here. What if, let's just say Jerome Powell does deliver 2 rate cuts before the presidential election next year? What do you think that does to the election?
I don't think it does much of anything. I mean, their dot plot already suggests that they're going to do, 75 basis points. They said that, in November. They said that earlier this year. They said that in July. And so I think a couple, rate cuts just to show they can do it. I don't think that gives, it's not, how's that going to help the housing market? How's that going to help used car sales, new car sales? How's that going to help a consumer buy more stuff? I mean, just put it this way, 75% of all mortgages held in this country, conventional mortgages, are 4% or under. So a couple little rate cuts on the margin isn't going to really stimulate much at all. It might give people hope. It might jack up the Dow Jones, but I don't think it's going to make a material issue if they do that before the election.
Lee, let me push back in a friendly way, because we always talk about buying on the dips in the equity markets, but for those who are looking to perhaps list their homes or waiting to get back into the housing market, there is still the mindset for those who are looking to perhaps buy on the dip in mortgage rates or sell on the dip and listing their homes so they can make sure that they're taking advantage of buyers that are making their way in. So wouldn't there be, and I mean, I guess that's just some thinking that's out there, wouldn't there be some type of reentry, at least even on margin, of people getting back into the housing market and perhaps there's being a spurring of some demand in that instance?
Well, of course. I mean, housing demand is not dead right now. People still have to buy homes. I'm a financial advisor during the day. I mean, I see people, I have clients who are buying and transacting houses. A lot of them are cash deals. Over a third are cash deals. But you still have people who need to buy, and inventory is still going to be tight, right? So until we see a more significant lowering of that spread between the 30-year mortgage, that conventional mortgage, and the 10-year treasury, we're not going to see a lot of uptick. Plus, remember, with housing, it's such a big part of CPI. It's really one of the key components that's holding us back from seeing that two handle that everybody can see, they can smell. A lot of people just like, why aren't we there yet? But housing is a major cost. So I don't think that we're going to see a lot on housing. I mean, this year housing prices went up. They didn't go down. And I think as far as reentry, you've got to get people out of their current mortgages. And when you only have a quarter of those mortgages supply over, say 5% or over, it's going to be hard to shake it loose.
Claudia, last word to you. If there is an economic surprise, a big economic surprise next year, where do you think it comes from?
My biggest risk on the economic side is that the Fed rattles financial markets in not giving clear guidance. So it's not a direct effect onto the economy, but they contained Silicon Valley Bank, really got that under control quickly. If the next time that comes around, they don't have such good luck, then we could have a real problem next year.
Really good analysis here. Appreciate it. Thank you for joining. Claudia Sahm, Sahm Consulting founder, and Lee Munson, Portfolio Wealth Advisors President and CIO. Happy New Year to you both.
You too.
All right, much more ahead. Really, analysis, Fed, markets at record highs, you name it, we got it. Yahoo Finance. Back after this.
The markets have rallied heading into the final trading week of 2023, just days left, with much of the optimism being put down to the dovish tone from the Fed, indicating around 3 rate cuts in the new year. S&P and the Nasdaq have clocked in highs not seen since 2022, tracking a 9th week of consecutive gains. Our next guest predicts this upside could last for several years, and has chosen some stocks which will specifically benefit from the predicted cuts to come. Let's bring in Thomas Hayes, Great Hill Capital Chairman. Thomas, I don't even know what I'm doing for the next several years here. You're anticipating stocks, and this could permeate, and this optimism could permeate for several years. What is the main catalyst? Because it can't be AI alone.
Yeah, well, this is what it looks like when 65% of managers are behind their benchmark. So we've had this huge year-end push. We've come a long way in a short period of time, and now consensus is we must correct in January and February. I think a lot of people are positioning for a 5 or 10% correction. I think the key is to zoom out, because if you actually look, we've had 0% gains since 2021 in the S&P 500. We're now just breaking out to new highs, and it's very hard to short new highs. So it wouldn't be surprising to see some consolidation in January, February, some volatility. But I think as you look forward, there are a lot of stocks that are just starting to participate that are at very low valuations that can perform over the next couple of years.
So what's the best strategy? Somebody watching this, they're seeing a market trade at record highs. Do you pour more money into Nvidia, even though it's up, 237% a year and trading at record valuations? Or do you sniff around some of these doggy healthcare stocks that have had terrible years this year?
I think the latter. I think you want to look at relative value. Large cap is trading at about 20 times forward, maybe now a little bit more than 20 times forward. Small and mid cap are trading around 14 times forward. So that's where you're going to find the real value and the real opportunities. So I do think that, if you look at presidential years, the average since 1928 is about 11.28%. With a sitting president running for re-election, it's about 13%. So those companies that make up the heaviest weights will probably do okay, but much less well than they did in 2023. So I think you've got to look under the surface, and I do think there's going to be tremendous amount of money made under the surface, even if the general indices are only up high single digits, low double digits in 2024.
You mentioned going into a presidential election, general election year. What amid what is anticipated to be a vitriolic campaign season that we're going to see next year, what could spook the markets? Is there anything that could throw us off course, especially given some of the concerns that we've seen geopolitically, or even where the Fed is going to perhaps have its own turnover as well going into next year, and where camps line up there?
Yeah, there's always something. I mean, we do have the geopolitical risk. We do have the Fed risk. I mean, you've got a wide spread between the Fed anticipating 3 cuts in the dot plot and the market anticipating 6 cuts. The Fed is still highly restrictive right now. If you consider where the Fed funds rate is relative to core inflation, you've got about 200 basis points of restriction. So they're going to have to close that gap. Maybe if we do see a little bit in oil, that'll help keep inflation a little bit above trend, and then they bring down rates modestly. That'll get us to a more accommodative state. But really, it's going to be a stock picker's market, and I think the real risk for the markets generally is not politics. It's if one party wins the executive, Congress, and the Senate, that's when you tend to get underperformance. As long as you have some form of blocking and gridlock, that's very, very positive for equities.
Like Brad mentioned, it could be a really volatile year because of the election. Are there certain stocks or names you think could just overcome this political rhetoric?
Yeah, there are a few that we really like, and they call me Turnaround Tom because these have really gotten hit off of the recent highs in 2021. So you've got 3 turnarounds. Number one, you got PayPal that was hit 85%. You got Generac that was hit 85%, and then you've got Crown Castle that was hit 55%. All of these benefit in their own ways from rates starting to normalize. My favorite right now is PayPal, and particularly because of a new CEO catalyst with Alex Chriss. Alex came from Intuit, where he ran the small business division. He was responsible for 50% of revenues, and over a 10-year period, that stock was a 35 bagger. So this guy knows how to do acquisitions, to do accretive acquisitions, to cut costs, to drive growth. And he's going to do that in PayPal. PayPal, his initiative is to turn it from a value stock. What do I mean by that? It's now trading at 12 times next year's earnings.
Amazing to see PayPal trading at those levels.
Yeah, it historically traded at 30 times. He's going to turn it back into a growth stock. And the key thing that analysts have been very negative about why it got derated down to 12 times is Braintree is 10% of the global large enterprise processing. Think they've got Uber, they've got Ticketmaster, and the margins contracted. The size increased, but the margins contracted. That's starting to reaccelerate since Alex Chriss came in the last quarter or so. As those margins start to reaccelerate, you're going to see multiple expansion, coupled with rates lowering can help with that multiple expansion. And we think this one, despite the fact it's up 23% in the last few weeks, we think this can go up another 50% over the next 12 to 18 months.
Make Generac sound sexy, because a lot of people are wondering why you chose that one.
Okay, so Generac has the same problem that many companies coming out of the pandemic, whether it was Intel, many others, they overstocked on the basis of not being able to get enough parts, worried demand was huge. They bought it the exact wrong time at the exact wrong price. They've brought inventories down from 2 times normal levels to normalized levels in the last 4 quarters. And the consumer often finances it. So they've been a little bit stopped out with rates going up. As rates start to come in, you're going to see more financing. And this is a covert play on the housing recovery. As rates come down, you're going to see more and more supply of houses come back on the market. Their commercial and industrial business has been doing fantastic, up 24%. They back up some of the cell towers, et cetera, data centers, et cetera. But that residential needs to come back. Now that you've got the inventories through, I think this is going to be a great play for 2024.
Turnaround, Thomas Hayes, Great Hill Capital Chairman. Good to see you and Happy New Year. Thanks for coming down.
Thanks for having me.
We appreciate it. Well, Brad, that's all from us today. Can you believe it? I thought we had about 8 more segments left here.
I mean, we can go for 8 more seconds, maybe.
All right, fair enough. Much more ahead on Yahoo Finance, on markets at record highs, and really some great analysis on some of the biggest tickers dominating our platform today. We'll be right back.
Welcome to Yahoo Finance Live. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo alongside Diane King-Hall. Here's a look at what we're watching so far this morning. Holiday sales didn't show many signs of consumer cutbacks, but could there be a hangover to come in the new year? We'll discuss.
And the market has rallied on investor optimism into year end. But what's next for the Fed in 2024? We'll speak to former Kansas City Fed President Esther George this hour.
That's right. Plus, it was a tough year for banks, except for one. JP Morgan is now worth more than Bank of America and Citi combined. But what does this signal for the big banks ahead? Well, before that, let's take a look at how the major indices are faring so far this morning. Looking at a mixed picture here, the Dow, the only one in the green, but ever so slightly up about 0.1% or 36 points. S&P 500 also down, but ever so slightly. We're seeing some of these tech-heavy hitters really weighing on it. Consumer staples and real estate, the biggest gainers so far. Tech, the laggard, as we see Apple, Google, and Microsoft under some pressure. And with that in mind, looking at the tech-heavy Nasdaq, down the most so far, but ever so slightly by about 0.1%. Taking a look at treasuries as well, continuing to see those yields retreating. The 5-year down about 1% on the day. The 10-year down about 1.2%, sitting at 3.84. And looking at that longest 30-year yield, that's down 1.3% as we continue to see that retreat from its highs. Well, the misery index, the sum of unemployment and inflation, is ending the year at 6.8%. Now, that's its lowest point since the pandemic hit in March of 2020. Items cost more, yet higher wages are helping offset that. Now, this means people should generally be happy. Yet looking at consumer sentiment, that's not being felt by consumers yet. Consumers are still spending big this holiday season, though, after retail sales showed continued resilience. But could there be a New Year hangover? Jeanette Garrity, Robertson Stevens chief economist, is here to tell us more. Thank you for joining us this morning. So give us a gauge of what is happening with the consumer. They should be happy given where wages are and inflation coming down, and they're still spending. But there is this strange dichotomy going on.
It's such a funny word, right? This word happy. I don't know what to make of it. But yeah, if you look at consumer spending, you got to say they feel pretty good, or they should feel pretty good. There's very little evidence, actually, economic evidence, that consumer sentiment directly feeds into those near-term spending patterns. It's really driven by income. Income is up. Job prospects, even though the unemployment rate has gone up a little bit, I think the general perception is that there is still a high demand for labor. And so people are sort of saying, why not? And so they're spending. I'll make a case that this month, these 2 months, November and December, this holiday sales is going to be the most surprising thing in the whole last 3 years of surprises. Because I think almost everybody thought that at this point, consumer spending would be slowing down, the growth would be slowing down, and that this might be a difficult holiday season for retailers. And I think they sort of planned accordingly. It's going to be interesting to see what goes on with their inventories. But spending is up. In November, consumer spending did what consumer spending has done in the past, favored goods instead of services, and it led by, guess what, video equipment and cars. And so this is very traditional, and I think it's very surprising to a lot of people.
And Jeanette, yes, indeed. It's been a kind of a lot of surprise when you think about both the economic picture this year. I mean, we kept talking about the R word throughout this year. That never materialized, right? And you think about the strength of the consumer as well. There were all these worries about the next shoe to drop, the worry that when student loan repayments would come back, and that was the next shoe to drop. But it's come back, and we haven't seen that really hit consumers like we thought it would. But what is the check engine light that you're looking for when it comes to how the consumer is doing in 2024?
Well, the check engine light, I think, definitely is, sort of consumer credit card balances, which have been trending up. The information we get from the big banks in particular about what they're seeing in their, checking accounts, which they've continued to signal they've seen those draw down from these unusual highs that they saw during COVID. So I think that's an issue. And then the unemployment rate. Again, we none of us expect the unemployment rate to go up substantially in the first quarter of 2024. But you can be surprised about that number. So I think if the unemployment rate turns around and starts deteriorating significantly, that'll be a big check engine light, if you will.
And Jeanette, we know that we heard a lot about the slowing consumer, at least on the earnings calls this past quarter. But if you're a business and you're trying to plan for what you think is going to be the consumer demand going forward, given that we're still in a high interest rate environment with the potential for cuts at some point, perhaps next year, how do you position yourself as a business?
Look, at this one's tough, and I don't know whether we're going to get a lot of insight into what really went on until, yes, maybe the earnings reports in January, but also some of the information coming from the government on inventories. If you're in retail and you're planning for holiday sales, you're putting those orders in July or August, and everybody still remembers supply chain problems, and so they may have even gone in a little bit earlier in order to get them. And at that time, there were a lot of forecasts for recession still out there. So how much did retailers build up inventories? How much did those inventories get drawn down by strong holiday sales? If they were drawn down significantly, then it'll be a positive for early 2024 because retailers will be building those inventories. That's a net positive to economic numbers. If they've got a lot of inventory still yet to be consumed, that's a different matter. Then you'll get a rather traditional further inventory drawdown in January, and that'll be a negative for the economic numbers. You just don't really know. It doesn't seem like there were many shortages this holiday season. That was watching big screen TVs, didn't seem to be a problem to get them.
Indeed, and we know when we think about the pandemic and how far we've come in terms of inventory management and supply chain, certainly night and day. Appreciate you taking the time to join us this morning. Jeanette Garrity, Robertson Chief Economist, thank you so much.
Thank you. Happy New Year, everyone.
Happy New Year.
Thank you, you too. Well, consumer staple stocks have had a challenging year in 2023, and investors are hoping for a sweeter 2024. Now, inflation was very much top of mind when it came to the American consumer's approach to shopping this year. But despite signs of a more selective consumer, Americans still had a sweet tooth for some tasty treats. The snacking business has been rather generous to companies like Mondelez, the maker of Oreo cookies, in recent quarters. Back in May, we sat down with Chairman and Chief Executive Officer Dirk van de Put to explain why the country has turned into a nation of snackers.
Consumers are still spending a lot of time at home. They got used to the brands, they got used to the product. So now when the inflation comes and prices start to increase, it's clear that they are attached to it and that they don't feel like they want to give that up. So that's the fundamentals of what's going on. You also have two new generations, millennials and Generation Z, taking more and more of a percentage of the consumption, and they eat in a completely different way. They're not 3 meals a day type of thinkers. So those two combined, that's really what's causing the success of snacks.
The amount of data you must have on consumers must be mind-blowing. So what you're saying is that maybe this next generation of people in this country not eating dinner, just snacking more throughout the day?
Yes. The average consumer now already snacks 3 times a day, and the percentage of people that's doing that is about 78%. So yeah, we clearly see that habit going up.
Mondelez wasn't the only one betting big on snacking this year, surprisingly. Campbell's Soup Company snacks business offered a bright spot for the iconic food brand in its fiscal third quarter earnings, but the company did see shoppers having some greater than expected resistance to price increases. Yahoo Finance sat down with Chief Executive Officer Mark Klaus back in June, who shared his concerns over what a tough economic backdrop means for consumers.
In a world of tough economic backdrop, and certainly as consumers are working to stretch their dollars the furthest, the temptation of a lower priced offering, and that's really what the dynamic is with private label. Is it's really about value. There are pressure in certain parts of our business that we have to continue to make sure that the value, not price alone, but the equity, the value, we're doing a good job on. That's why, for example, in condensed, Where we've seen some of that pressure from private label, it's not coming through on the parts of the business that really we have the most compelling point of difference. And so for those other parts, some of our flankers like Healthy Request or our more expensive condensed offerings, we've just got to make sure that we're providing a great proposition for consumers. But as far as like long-term migration into private label due to quality, I'm not concerned about that at all. We continue to be the winner in the categories we participate in. And I do think that in the fights that we've really made sure are most critical, we're continuing to win.
So economic uncertainty hasn't scared off consumers from that hot snack market. Consumers are just prioritizing snacks on their terms. General Mills, the maker of iconic cereal brands like Cheerios and Cinnamon Toast Crunch, sees its snacking business gaining share in the year ahead. Now, back in September, Jeff Harmening, Chairman and Chief Executive Officer, sat down with Yahoo Finance to discuss his confidence in consumers' purchasing decisions and explain why more Americans are looking to find value in the places they shop.
You know, consumers just finding value, trying to find value in places where they shop. And so they're looking for places where they can get a better deal. And that might be a club store, a mass merchandiser, or a dollar store. But they're also looking at things like the package size itself. And if I was getting a large size, now maybe I want to get a medium size because I want to make sure that things don't go to waste. Importantly, they're still looking to our brands as they always have, because it's also important when you don't want to waste food that your family's going to eat it. And when you have products like General Mills with our $9 billion brands, they got there for a reason, and that's because consumers love them. And so even though consumers are looking for value, that doesn't only mean price. It means convenience, it means great taste, it means nutrition. It really means something your family's going to eat.
Today is Fed Day, and the Fed is likely to come out and say, well, inflation has moderated, but now it's starting to pick up with oil back over $100 a barrel. How concerned are you about the inflation outlook?
Well, we've been dealing with inflation for the last few years. If you look at the last 3 years, including this one, inflation for our business is up 30%. Now, importantly, as we look at the year ahead, inflation is only 5%. So it's moderated from 13% last year to 5% this year. So it's gone down, but it hasn't gone away. And it's hard for me to see a scenario where inflation is going to go away completely. It's at 5% for us this year. For us, the good news is we have productivity gains, and that's our first line of defense. We have generate about 4% of savings in productivity every year. We have a little bit of pricing. And so we should be able to manage this okay. But for the viewers who think that inflation is going to zero, that's not the way we see it. And we believe that labor will probably be the main driving force of inflation, even if it's going to be less than what it was a year ago.
So as we look ahead to the new year, consumers want to know what's in store for these consumer goods companies. Well, most executives saw shoppers staying loyal to their brands this year, despite some price increases. PepsiCo has planned some modest price hikes in 2024. Former PepsiCo CFO Hugh Johnston saw demand holding up for the snack and soft beverages giant, despite a murky inflation picture in the new year and persistent geopolitical risks.
We do think inflation will be a little bit elevated relative to the pre-pandemic levels, as I mentioned earlier. And we've basically been pricing in line with inflation. That's kind of been the practice over the course of the last couple of years. So if inflation's up 10%, our pricing's been up about 10%, something in that range. I think next year, given we're going to be a little bit elevated, you'll see our pricing be a little bit elevated relative to history as well, but not to the degree that it was over the last couple of years when inflation was especially high.
Hugh, PepsiCo is a company with a long-standing international presence as well here. When you think about some of the larger conflict that has emerged recently and then the conflict that continues to persist, geopolitically, it's extremely murky to figure out how some of both U.S. and some other international businesses around the world continue to navigate this without pricing pressures that cascade down to consumers. How are you approaching this at Pepsi?
Well, thankfully for us, our international portfolio is quite large. We're in almost every country around the world. And the reality of it is, unfortunately, historically, there's always been disruptions somewhere in the world of one type or another, whether it's conflict or weather or other natural events. As a result of that, we typically, with our portfolio, can manage through those types of things pretty successfully. And as we've sort of thought about our guide for next year, we incorporated all that we knew right now, anticipating, I'm sure there'll be another disruption or two somewhere in the world. And we should be able to manage through it despite all of those things.
Meantime, first wave biopharma shares are rallying today, jumping more than 150%. This comes after the biopharma company agreed to sell its treatment of inflammatory bowel disease to an undisclosed company. Now, First Wave saying the agreement includes a 7-figure upfront payment, future milestones, and royalty payments. The deal is expected to close in the first half of next year. So talk about a huge rip to the upside, Rochelle. That stock, again, up more than 150% at the moment. And now keep in mind, this is a sub $1 billion market cap company, so it definitely has room for growth in this space, certainly putting the biotech sector in focus this morning. But if you want to kind of put it in perspective for where it is for the year on a year-to-date basis, the stock is down 92%. But again, you're seeing this rip higher off this deal news today, Rochelle.
It's true. I mean, you consider its 52-week high was at $179 per share, considering where it is now at sub $10. But it's interesting because the program that it's selling, it's going to an undisclosed biopharmaceutical company. So we have a lot of biopharma companies really making up the top trending tickers at the moment on Yahoo Finance. And this is a one-day record high for the company. It was up, as I think, more than 170% on the day before paring back a little bit. But we've seen a lot of movement. Anytime we see some of these clinical trials either fail or do well, we see this massive jump. But it is worth keeping in mind of where the stock is now versus where it was at its 52-week highs. But we'll continue to track that one.
All right.
All right, we still have all your markets action ahead. Stay tuned. You're watching Yahoo Finance. Investors looking to manage volatility and diversify their portfolios often turn to ETFs. And Verify found that these themes dominated ETF trading in 2023. Discretionary spending saw overall high performance persist, with e-commerce growing its market share. There was a shift in strength to on-demand cloud-based entertainment, while the rise of EVs remains fragile, with eyes moving towards other autonomous tech. And crypto ETFs saw a resurgence of interest in the possible launch of a spot Bitcoin ETF. But will these themes remain as prevalent in the new year? As part of our ETF report brought to you by Invesco QQQ, let's bring in Sean O'Hara, Pacer ETF's president, to discuss more about what to expect in 2024. Thank you for joining us this morning. As we look at things like You're very welcome. As we look at how the Magnificent Seven has really pushed this rally and people trying to sort of find their way in, what are the expectations for how to play this with ETFs in the new year?
Well, I think this is kind of a unique year when you think about it. 7 stocks controlled basically 100% or so of the return of the broad indexes. And so that's something that happens from time to time when you do get these markets where there's an over concentration in a small number of names, but it never lasts. And so I think as you start to think about next year, finding different ways to weight portfolios, like, for example, if you are an S&P 500 investor, there's an equal weighted version of the S&P 500. I think the ticker's RSP, or you can buy an equal weighted version of the Nasdaq 100. And the idea behind that is that there's only really 2 ways for this to sort of play itself out, and that is these big 7 names come back down to earth. And so if you stayed in the regular S&P 500, you'd get hurt more by that versus broadening out and going equal weight. And then the second piece of it is that if we have the bottom names coming back up, there's not enough weight in these indexes for it to make that much of a difference. So an equal weight approach would do well in that environment as well. Or you could look for other fundamentally weighted type of strategies, things that look at earnings or revenue, or like what we do at Pacer, we use free cash flow and free cash flow yield to screen for stocks.
Sean, when you think about AI, it's been a dominant theme this year. We talk about the Magnificent Seven and how much that's factored in terms of how investors have played this market and how that's really been the winner. How do you invest in the ETF space to take advantage of the AI play in 2024?
Well, we have an ETF, the ticker is TRFK, traffic. And so the idea was, this sort of evolved pre-AI being the top story. We just believed we're in the midst of a technological revolution here. And so when you think about what makes that possible, whether it's streaming or the cloud or artificial intelligence is the big part because it just eats up so much data. We basically took the guts out of the data centers and said, if you're going to own the component parts that are inside these buildings that do all of the computing work, and you were to figure out how to put a bunch of those names together. And that's where the idea behind traffic came from. So we own all the big AI names. We own Nvidia, Snowflake, Palo Alto, Intel, but it's a little bit more diversified approach. And so I think, AI is going to continue to be a big story as companies try to figure out how they're going to monetize it or benefit from it. But in the meantime, the folks that I think will continue to make the money will be the chip makers and those people who provide sort of the nuts and bolts that go into the servers that power this whole thing.
And Sean, I want to hit on another theme, of course, interest rates, and wondering what the Fed will do, how soon it will end up pivoting on interest rates. But if you're looking at some of the ETFs in this space, what are you seeing in terms of inflows as we head into the year, as we heard more of that dovish talk from the Fed, and how will that perhaps change once we do see a rate cut?
One of the biggest surprises we saw this year was we saw fairly significant flows into our small cap ETFs. And I think small caps, have underperformed, and generally speaking, for a while. And I think there's people that think that, maybe that cycle can turn. I think if you're thinking that way, I think you need to be careful about the overall broad market in small caps. If you looked at the indexes like the S&P 600 or the Russell 2000, somewhere around 30% of those names in those indexes don't make any money. And small caps are more highly levered than large caps. And so as rates have risen, a good number of those names are going to get hurt by that. And the overall cost of this financing across those broad indexes is somewhere around 30% of earnings. And so be selective if you're going to think about, owning some small cap stocks going forward. And so we screen for free cash flow and free cash flow yield. And so when you think about the names we own versus the broad index, they have far greater excess free cash flow to deal with rates being high. And if they remain, high for a while, say the Fed doesn't really pivot, that'll continue to be a challenge for the broad indexes. And I think it will be something that might be an advantage for us.
Sean, another theme that we have to pay attention to in 2024 is, of course, it being an election year. So how does one play the ETF space in an election year?
Well, generally speaking, I think in an election year, the market tends to do well because the incumbent is trying to do everything they can to get the economy going and to get things moving and get people feeling better about themselves. And so I would expect next year we'll see a fairly decent return in the market, so long as 2 things don't happen. So long as we don't wind up with a significant disappointment on the earnings side, I mean, I think the expectation is for roughly 10% year over year. And so that could potentially be a, sort of a little bit of a headwind if we come in lower than that. And then the second thing, and I think we've pulled some of the returns from next year forward into this year based on everybody's view that the Fed is actually going to cut and how much they're going to cut. And so if they don't wind up cutting or don't wind up cutting as aggressively as currently priced in, then that's potentially an issue. But, if you take those 7 stocks that everybody, has been talking about that have driven the returns, and you set them aside, the rest of the market is really well priced. I mean, the rest of the S&P 500 is probably priced at, 12 to 14 times earnings when the overall broad index is priced at, north of 20. And so if you wanted to be cautious in a year like that, you would find ways to sort of avoid those higher PE names and to concentrate on names that have lower PEs that are high quality companies that pay dividends, for example.
All right, Sean O'Hara, we'll have to put a pin in our conversation. Thanks so much for joining us ahead of the new year. Sean O'Hara, Pacer ETF's president.
Happy New Year.
Happy New Year. The whirlwind of innovation that has come from generative AI has been the talk of the town for all of 2023. Investors have been focused on the latest and greatest, but also potential risks that the technology offers. And 2024 will only bring more of that conversation to our doorsteps. At Yahoo Finance, we've sat down with some of the leaders in the field and spoke to them about it, from their optimistic approaches to the challenges that they found in adoption. For instance, we had Mark Benioff, Salesforce co-founder and CEO, speak with us about how AI technology is going to recreate industries and businesses. Let's listen.
This is the most exciting business opportunity of our lifetime, maybe any lifetime. I mean, it's unbelievable what is happening. Every business will get recreated with artificial intelligence. People are here trying to understand how to do that. How do they do it for themselves? How do they do it for their businesses? And I think this is something that is widely unexpected, that a year ago, you're right, we're kind of right in the heart of cloud computing, mobile, social, the enterprise. Now everything is getting augmented with artificial intelligence. You really see AI really in 4 different waves, and the first wave is what we've been experiencing over the last 10 years, which is predictive. Now that predictive wave, well, all these customers, they've had their hands on that for a decade, and that's what's delivering those trillion Einstein transactions every week. Now we're in the new world, generative AI, everybody understands. That's all about these new large language models, the ability to put things together, to have this kind of free-form artificial intelligence in a chatbot type world. The third wave that's coming is more autonomy, more agents. That is where you have the software working on your behalf, doing things without you actually giving it instruction. And the final one is when it's kind of thinking for you.
And Pat Gelsinger, Intel CEO, also weighed in on which sectors he saw being impacted by the industry the most.
Enterprises are just going to find a lot of critical use cases for this. We showed a couple today, in some of the communications technologies. Imagine real-time translation, transcription, summarization, contextualization. Wow, this is cool. But also cases like manufacturing lines. And we showed even our manufacturing line where high resolution imaging and being able to detect machine variations and being able to improve line yields in our big factories. Wow, 1 day of improvement, and I paid for every PC upgrade I would ever do. So all of these use cases I think are important, but consumers as well. Content creators are going to find these to be much more productive ways. And we had a musician here showing off a project that would have taken her weeks now was getting done in a single day because of these new generative capabilities. So much like the Centrino moment, AI PC is for everyone. It's a new generation of PCs, and we're just getting started. We had 100 application vendors here with us today, and we expect hundreds more are going to find exciting use cases that we haven't even yet imagined for the AI PC. One of the things, and I commented on this in my keynote, that some people are a little bit concerned, it's sort of like artificial intelligence over there. What's it going to do to me? And I suggested that we might reframe it as augmented intelligence. where we're making it part of how we live, how we work. One of the things is, hey, I wear hearing aids, a family defect, and I now have neural enhanced hearing aids. It's not over there. This is part of improving my life and experiences. When it's in my PC, it is making me more productive on a daily basis.
And sitting down with Lisa Su, AMD Chair and CEO, offered insights into how AI has pushed innovations in chip makers in 2023, but also a preview into potential headwinds.
It's the most complex, chip we've ever built. It's the most complex chip, frankly, in the industry. And the way you do it is, let's call it, with a lot of technology. So we're super excited about the capabilities of, MI300. If you think about just how important AI has become, right? AI is like in every conversation, no matter which industry you're in, no matter what you're trying to do. And for AI, you need these extremely powerful GPUs. And they're very, very few companies who can build these things, and I'm just so excited and really love being part of the opportunity to really change the industry with our AI tech. We want them to be as good as possible. We want them to help us answer questions as quickly as possible, and we want the answer to be the right answer. And so these models are going to get much more accurate. They're going to be much more tuned to your data. Particularly when you think about your own personal space or your own enterprise space. And for that, you need lots and lots of GPUs. Today, it is one of those constrained resources. Our job is to make the technology better and ensure that there's plenty of opportunity for, all companies to have access to this great technology. I would say that this moment is, just unlike any other moment. So, I've been in this industry, 30 plus years. We've seen a lot of great technology, but AI is a step function above that in terms of what we believe the potential is. Now, we do have to put in safeguards. I think there's a lot of work going on in that area, but the upside, far outweighs the potential risks.
And to round it out, Andrea Guerzoni, EY Global Vice Chair, gave us all more nuance into some of the challenges business leaders are having keeping up with AI adoption.
On top of every CEO's agenda, it's the buzzword now. But at the same time, when it comes down to adoption and understanding really the value that can be extracted from this technology, it becomes much more complicated. So our survey showed very clearly that almost 2/3 of the 1,200 CEOs we interviewed are struggling with the actual application, and they are keeping themselves in terms of talent, in terms of educating the management teams, hiring the right people, but at the same time, the application is not that easy.
Andrea, what do the partnerships look like when they're talking about furthering their progress and adopting AI? What does that strategy look like? What are you hearing from business leaders in terms of how they're approaching that?
I think they are very cautious. I think the technology is evolving extremely fast, and there's a huge fear of making mistakes. The cost associated with this technology is very high. The development of proprietary language model to ensure safety in the use and effectiveness in the adoption, it's an element of complexity. So they are trying really very hard to understand which use cases can be adopted first to test the technology, to develop further use cases down the line. I think the first applications are really more related to efficiency, trying really to reduce costs, to trying really to understand better how this technology can evolve. And I think the next step will be definitely the impact that these technologies can have on the top line growth. And finally, really devising a strategy that would allow companies to redesign their business models, their processes.
Those AI opportunities not slowing down anytime soon. All right, stay with us. All your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Investors are rallying around optimism into the year end. Fed officials left interest rates unchanged in the final meeting of 2023, but comments from Chair Jerome Powell fueled confidence in rate cuts to come in the next year. For more on the Fed's path forward, we're joined by Esther George, former Federal Reserve Bank of Kansas City CEO and president. So thank you so much for joining us this morning. I want to ask, I know you recently sat down with us last month and you talked to us about the Fed potentially having time to pause and kind of assess where things stand. Is that still your view coming out of the latest meeting earlier this month?
Yeah, so I think the Fed has been encouraged by the data that they've seen coming out over the past few months. Inflation continues to make its downward drift. The economy, the consumer has remained resilient throughout. So I think their pause around further rate increases has served them well in terms of watching how the data's unfolded.
And a lot of investors are wondering, when is enough data going to be enough? Is anything short of the Fed's 2% inflation target going to be enough to warrant a pivot?
So it's a great question. And as we've seen coming out of that last FOMC meeting, there was a tremendous response of anticipating rate cuts. And I think the caution for me is that the Fed is not at its 2% target. They are being mindful that they may be able to back off of some of these interest rates once they become fully convinced. But right now, this is a forecast of inflation continuing to fall. And we know historically that a policy that jumps too soon to those rate cuts can be costly later. And so I think it would serve the Fed well just to continue to watch this data before reacting too quickly to believe that it's achieved victory or certainly even a soft landing.
And speaking of kind of, I guess, the timing factor, you've talked also previously with us about saying more time is needed for interest rates to work through the economy. How much more time is needed?
So when I look historically, it can take some time before those policies work through, sometimes up to 2 years. We saw that in the 2005-06 rate hike cycle, where rates paused in 2006, and it was nearly 2 years before you began to see some of the full effects there. And of course, in that time period, it was a bad recession that resulted. So that's not my forecast here. My point is, I think for the Fed to declare victory too soon could also be as dangerous as holding rates too high for too long. And that, of course, will require them to watch and see over the next few months if the data continue to cooperate on inflation.
And it certainly is a delicate balancing act. The Fed, of course, in the beginning accused of coming into the inflation picture too late and now afraid of perhaps cutting things off too early, declaring victory too early and risking more damage and being back in the same position. But I do want to ask you, because obviously we see the markets move with every bit of data that comes out, every bit of dovishness that comes out. Markets are just sort of off to the races here. We had Claudia Salmon earlier on Yahoo Finance saying that markets are looking for some clear guidance from the Fed. Are they ever going to get it? And should that even be something the Fed should consider when they see these market swings?
Well, it's true. The Federal Reserve has, over the past decade, relied on guidance to the markets in the form of language that policymakers call forward guidance. I think they've now come into a time where they're trying to be quite careful about the language they use. And so seeing the press conference, seeing the chairman talk about the idea of rate cuts really fueled some of the reaction in the market that cuts might be coming sooner rather than later. And again, this is part of the tightrope that the Federal Reserve will be walking, which is not stopping too soon, not cutting too soon, and yet not holding tighter conditions than they need to. And that is a very difficult time, risk on both sides to how they look at it. In the long run, accepting risk of higher inflation, I would argue, is much more costly. And so they'll have to just be quite sensitive to whether their forecast and their confidence in those forecasts are high relative to that inflation, getting back to target in a sustainable way, not just hitting it, but sustaining that 2% target.
Indeed, sustaining and almost to see that blip and then see everything reverse. Appreciate you taking the time to join us this morning. Esther George, former Kansas City Fed president. Thank you for your time and Happy New Year. All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance. ...2023 has been a tough year for banks. Deal-making slowed, jobs were cut, and there was a crisis in the regional banking sector. The collapse of Silicon Valley and Signature banks contributed to the biggest year of failures since the 2008 financial crisis and caused huge fears of a recession, which ultimately did not materialize. But the financial sector has rebounded since its dip in March and is now up around 10% year on year. But one lender is leading the charge when it comes to gains, and that's JP Chase, which is shown in our chart of the day. Now, this one from Bloomberg shows how the country's biggest lender is now worth more than Bank of America and Citibank combined. JP on track for its biggest annual profit, 26% higher than last year, and what is predicted to be the largest in the history of American banking. Those diamond hands paying off there.
Yes. Oh my gosh. Yes. Diamond hands. I mean, JP Morgan Chase, known to have a fortress, a balance sheet, being rewarded for being the Goliath within the banking sector, although I don't know if that's the best analogy. But to explain more about how JP Morgan Chase is set to continue to be America's biggest bank and what's to expect in 2024, we want to bring in Yahoo Finance's David Hollerith. So David, thanks so much for coming on today and kind of breaking down where JP Morgan Chase stands and how it's set up for the year. I mean, we had Jamie Dimon on earlier this year, and we've had people come on our program and talk about how much he's done for the bank. So, David, where does JP Morgan Chase stand when it comes to 2024?
Yeah, I mean, I think if we just look at the last quarter, which is still has not quite ended, JP Morgan is a really big bank, and it's expected to show full year 2023 profits on par with the GDP of the country Jordan, which is just gives you an idea of how large they are. Now, one of the main reasons why JP Morgan has outperformed other big bank peers has been that it's largely navigated around some of the pitfalls that those peers are dealing with. And that's due to it playing more conservatively. And this is not so much of something that's happened this year as something that JP Morgan has been doing for years. Now, of course, the bread and butter of banking is taking in deposits to make loans. And big banks have an advantage there. That's largely a story of scale. Smaller banks have been having to pay higher costs during higher interest rate increases that we've seen over the past year and a half. And so that's obviously been a benefit to the largest banks. Crucially, though, JP Morgan this year has stood out by being able to purchase First Republic Bank from the FDIC. And that also proved to be sort of a game of scale. JP Morgan was competing against smaller banks, and ultimately it offered the best deal to the FDIC. Now, we can also sort of take this and flip it on its head and just kind of look at some of JP Morgan's peers just to kind of evaluate what it's dealing with versus the peers. Now, Citigroup and Wells Fargo are both dealing with profitability problems that have been years in the making. Citigroup is trying to pull off an aggressive reorganization after decades of sort of showing how being too big also can have its issues. Regulators have also capped Wells Fargo. They've capped its ability to grow its assets, and this has been due to the fake account scandals it had during the 2010s. Also, Bank of America, which has still been fairly profitable this year, is still dealing with high unrealized bond losses. And that's been perceived as an earnings issue going forward. And that's largely why its stock has sort of lagged the other peer big banks. Now, going back to all this, JP Morgan hasn't been facing any of those problems. As far as management has said publicly, the biggest issue for JP Morgan next year will be trying to compete with the record profits it's had this year. I'd also point out, too, that if next year proves to be a year where banking generally does well, we could see investors seeking out more risk within the banking sector. And if that's the case, JP Morgan could be perceived as potentially too safe. This has been something that portfolio managers have sort of brought up to me. But, obviously this year has been incredible for the bank. And, they have had a very good track record recently of outdoing expectations and earnings. So we'll be looking for that in early January when they report full year earnings.
Fascinating stuff, especially for people looking for some of that potential upside in the banking sector next year. Appreciate you, as always, our very own David Hollerith. Thanks so much. All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance. Toyota stock rising today on news that it's seeing strong demand from the US and Europe and that it's hit a car-making milestone. Let's bring in our autos reporter, Pras Subramanian, who's been looking at those numbers. Pras, what are you seeing?
Hey, how's it going, Rochelle? So yeah, Toyota, big year for them so far. Talking about how they smashed an annual production record. So looking through here from a production standpoint, from January to November of this year, Toyota's global output hit a record of 9.23 million vehicles from a production standpoint. From a sales point of view also, they expect sales for Toyota and Lexus vehicles globally to hit 10 million in 2023. That's pretty huge there. And the month of November, actually, they had a big month, sales up 13.6%. So they're sort of hitting on all cylinders here. Pretty remarkable for Toyota. You know, they were once criticized for maybe going too slow from an EV standpoint. They're actually showing that, hey, actually, there's a lot of demand here for our vehicles across the board, from high-end Lexus to all the way down to the cars like the Corolla, which are actually not EVs. And they're also showing that hybrid-powered cars are doing well here. That's what people want these days across the globe, it seems. And also, Toyota's designs are improving. The new hybrid Prius looks really good. They have some new sports cars like the 86 and things like that that people are sort of resonating with them. And buying a car is still a emotional decision, so that's sort of why we're seeing Toyota here maybe do well, not just from a practicality standpoint, but also a design standpoint.
So, Pras, though, you used an analogy. You said all firing on all cylinders. Let's use another one. It might not be all systems go when you think about Toyota, because we have this news out today that Daihatsu, this is a car maker, Japanese car maker owned by Toyota, has had to halt production after admitting that it had falsified some data and safety tests, and this had been going on for decades, apparently. So what is the story there?
So Daihatsu, which is a maker of cars for Toyota that they own, but also make cars for, I believe, Mitsubishi and other companies in places like Malaysia, Japan, in Asia, stuff like that. They admitted to the fact that they falsified some of these crash test safety records, talking about how, quote, an internal investigation found that there was tremendous pressure on workers to meet their sales goals and not halt production. And also, you see here the quote here from Daihatsu CEO Soichiro Okudaira saying that at the press conference last week, we betrayed the trust of our customers. All the blame is on the management. I want to say that his name again, Soichiro Okudaira. I want to be careful about that.
Good.
So basically saying management was to blame for this. We pushed the workers to release these cars. We knew the tests were not safe. It's really a huge black eye for Daihatsu and even Toyota in their local market. So not good there. Production is going to stop through the end of January with 9,000 workers affected.
All right. We'll certainly continue to track that story. Thank you, as always, our very own Pras Subramanian. Right, now to an update on a story we've been following closely. An Apple Watch import ban has been temporarily stopped by a US appeals court. It means the tech giant will still be able to sell the latest version of the product during the busy holiday season. A ban would impact the Apple Watch Series 9 and Apple Watch Ultra 2 and comes after a patent dispute with medical monitoring technology company Masimo. The tech giant filed an appeal to the International Trade Commission after the Biden administration decided to let the order banning the watches stand. Even though the stock price was already off today, it is paring back some of those losses, but still down about 0.5% so far. Well, that does it for now. I'm Rochelle Akufa with Diane King Hall. Thanks for watching Yahoo Finance, and stay with us.